Good morning, everyone. It's 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman. Here are the three things that you need to know to start your morning. It doesn't get much bigger than this. 30% of the S&P 500 reports earnings this week, with Microsoft, Alphabet, Meta, and Intel as the standouts as results season ticks up a gear. The consumer also in focus, with McDonald's, Chipotle, and Coca-Cola out with numbers. Not a bad time for the Fed to show its hand. It's widely expected to hike rates a quarter point on Wednesday. All of that would be enough, but you can add PMIs, consumer confidence, and new home sales data into the mix as well. Tesla shares slip as UBS downgrades the EV leader to neutral from buy. Its price target is up to $270 from $220. The Swiss bank saying upside risk to consensus earnings is limited, with significant volumes from new products not kicking in before the second half of next year. The Cybertruck is the key one here, now closing in on 2 million reservations. We know it's becoming very much a volume game for Elon Musk, but shrinking operating margins have weighed on shares in recent months. Despite that pressure and some high-profile downgrades, Tesla shares have more than doubled this year. And Mattel's stock is on the up this morning after Barbie took top spot at the North American box office in its opening weekend. It also broke the record for the biggest first weekend box office take for a film directed by a woman. The Warner Brothers movie taking a big $155 million in North American ticket sales and beating out competition from the Super Mario Brothers movie to mark the biggest opening of the year. Mattel reports second quarter results this Wednesday, so look for a big Barbie-induced mention there.
And it's a big week for investors, with a long-anticipated Fed rate decision on Wednesday, large-cap tech results in the shape of Microsoft, Alphabet, and Meta. Our next guest says the air is getting thinner for further gains, especially in equities, but the macro backdrop and a likely positive second quarter reporting season still supports a continued risk-on stance. Joining us now is Max Kettner, HSBC Chief Multi-Asset Strategist. Max, it's good to see you. Good morning to you. So it sounds like you're sort of trying to weigh the bullish and bearish factors right now. And it sounds like that balance is a little more delicate than it has been. So talk us through kind of how that scale is working for you.
Yeah, good morning, Julie. I think, it's been a bit, it's got a bit more delicate now, because when we look a couple of months ago, I think particularly on the sentiment and positioning side, it was very, very clear when we looked at all of our sort of shorter term sentiment and positioning signals, they were very depressed, right? So we saw really sort of systematic positioning, discretionary positioning, options-based positioning, ETF-based positioning, all this sort of stuff was really depressed. We had very, very depressed growth forecasts. And then it was sort of easy for us to really proclaim and really tell the bullish narrative. I think when we look now, for example, at things like the pricing of equities versus fixed income, look at equities versus the 10-year, for example, that's sort of starting to price a global PMI of 52. It's quite a chunky recovery already, right? So there needs to be some confirmation now. We do think there is perhaps a little bit of upside risk really for global manufacturing. A couple of those leading indicators, particularly for US manufacturing, have picked up lately. And I do think that particularly now the earnings season, particularly the US Q2 earnings season, that's going to be also a near-term catalyst. But after that, and after, perhaps manufacturing even's picked up, I think then it's getting a little bit thin for risk assets for further gains.
And so we've tried to kind of pair this with where we're at in this kind of broader inflation cycle. Where would you say that we're at, Max?
I think we're still in that disinflationary Goldilocks cycle. So for us, it's still the stage at, the investment or the inflation cycle where I want to play that disinflationary theme plus growth actually doing quite fine, right? Yeah, of course, manufacturing is still sort of the weak spot, but if you look at the consumer's doing fine, the labor market's doing fine, right? Real wage growth has been turning positive now for quite some time, particularly on a sequential basis already. When you look at the weaker dollar, that's going to help earnings revisions in the US in particular in the next couple of months. It's also helping, obviously, global growth, right? US housing surprises are running on a 20 20-year high. And at the same time, as you were asking, inflation is still going down. So all of that is still a very sort of Goldilocks outcome for the market, where you want to be long US equities, you want to be long maybe sort of emerging market ex-China. So in total, it's an environment where you want to be long carry, right? The sort of emerging market debt, high yield credit, and the growth side of things in equities, i.e. the US and a bit of EM.
At the same time, you say you're tactically overweight, which makes it sound like you want to be nimble here. And you also say things could get a little hairy at the end of the summer. What are you looking for as those potential risk factors?
Yeah, but to be perfectly honest, we've been basically saying that we're tactically constructive since the start of the year, and we're sort of just extending our tactical bullishness every other month. So I think the main issue and the main problem that me and the team are really facing is that we're running out of potential headlines to stay still bullish and still constructive. So I am a taker of any creative ideas, but we're sort of running out of really particularly bullish headlines. I would say the earliest we're really facing those issues is end of Q3, beginning Q4. If then perhaps, some of those base effects in inflation are turning higher, we'll perhaps see headline inflation in the US pick up again. And then perhaps some of that, immaculate disinflation theme that the market is playing right now, and that perhaps can be questioned. And then, on the basis of that, we might see a bit of a pullback in risk assets. But I don't believe it's anything else other than a short-term pullback that then has to be bought. Because if we do look at aggregate sentiment of the largest real money investors worldwide, which we track once a month, then it's becoming still clear that even with the second half outlooks, that there is still on aggregate underweight equities, underweight high yield credit. So all of that really, really prevents a large-scale drawdown.
So does any of that scream recession to you?
Not at all. Not at all. I think that is very, very clear. Nothing of that screams recession. I think, if anything, the risk is much, much higher that we're going to get perhaps, with, like I said, right, the weaker dollar and US housing surprises on a 20-year high. And look at financial conditions, right? Look at broader aggregate financial conditions. They've eased, whichever index you use, whether you want to take, the Federal Reserve's indices or some others. They've eased, right? They've eased in the last 9 months. And it's no wonder that they did, right? Equities went up, the dollar went down, credit spreads tightened, volatilities are lower everywhere. So that really doesn't scream recession. It screams that we're perhaps closer to things becoming better in the US, not worse.
And Max, just lastly, sort of in sharp contrast to all of this is what we seem to be seeing in Europe. I mean, this morning, for example, we got a European PMI that was not great. So while you like the US, it sounds like maybe you're not looking to home turf.
Yeah, not anymore, sadly. So we're on aggregate underweight European equities, so that's Eurozone and UK, because just as you said, right, like the positive surprise catalysts, we're running out of that. And I think particularly with perhaps a little bit more sort of measured stimulus out of China, that also doesn't really bode well for the European manufacturing sector, doesn't bode that well perhaps for some of those overcrowded trades that we had in the first half. Think about luxury goods, right, in the first half of the year. So all of that, right, and with the Eurozone in particular still being somewhat of a consensus long, right, among investors, that doesn't bode well really for European equities towards the second half. In particular, bear in mind what the weaker dollar is a tailwind for US earnings. That also means that the stronger euro now in the second half is going to be a headwind for Eurozone earnings. So that doesn't help either.
Max Kedner, HSBC Chief Multi-Asset Strategist. Max, appreciate the time as always. Thanks. Well, as the market continues to climb, a wider swath of stocks are joining in on the rally, but cracks are beginning to show, signaling that a trend change could be soon ahead. So just how hard will the market be hit, and can the rally recover? That's the big question. We're diving in deeper to those warning signs now with Mark Newton, Fundstrat Global Advisors, Global Head of Technical Strategy, alongside our own Jared Blickery. Thanks, guys.
Thank you. And Mark, it's great to have you here today. We did a comprehensive webinar last year. Encourage everybody to look for it online. But today we're going to be talking about, let's begin with the S&P 500, just kind of a 30,000 foot picture here. Here's the year to date, definitely broken to the upside here. Just tell me what you're seeing in terms of the market action and what you perceive, what you think is going to happen in the near term future. I know August you think we may be in for a little bit of a tumble.
Thank you. Well, look, the market's proven to be a lot more resilient than I think a lot of people expected heading into this year. I mean, we went from a lot of worries with regards to possible, recession on the horizon, downward earnings revisions, and recently people are saying, well, the market's overbought, there's selective participation. But the move over 4,200 was certainly important, and it's helped to really lift equities. My thinking in the near term is that we are approaching a time when we can see a 3 to 5% correction in the month of August, and that has to do with seasonality turning a little bit negative. It's really one of the worst periods in pre-election years, August and September.
Well, let's dig into that a little bit, and then we can get into some of maybe the false narratives that are being are pervasive right now. Right. So you might be saying, what are you looking for in terms of the market rolling over? Because there are some very specific things on your list, and I'd like to go over some of them.
That'd be great.
Yeah.
Initially we have to look at sentiment having gradually gotten to a little bit more optimistic. Investors are finally respecting this rally, which they hadn't done in months. So we've seen a little bit of a flip-flop in negative sentiment to now more optimistic. We see short covering by institutions. I would argue it's not incredibly optimistic. Everybody I talk to is still somewhat negative on the market. They're waiting for the pullback. They don't want to buy NVIDIA at 450. They want to wait till it goes to 300. And so people are not participating on a larger level, but short term we do see some evidence of investors at least trying to play catch up. A lot of call option buying and initial signs of potential speculation.
Well, and let's talk about some of the things that people have been complaining about in this rally so far that may not be the case. Low volume. I love this one because I haven't seen index volume be participation in a bull market since the early 90s, maybe, at least at the index level, but no volume, too much concentration. I think we've seen some of that, a lot of that abate over the last month or two, the market rallying. What else are you looking for here? What else are you seeing?
Well, you hear people say the market's overbought, and that could be the case with regards to Nasdaq 100, but certainly not with equal-weighted S&P. So we strip out all these large-cap technology stocks. We see that the market's been down over the last 3 out of 5 months up until we hit the month of June. So that's recently a big broadening out of the rally. And when they say selective participation, they say, well, it's only been technology. And that also is not the truth. I mean, technology has underperformed over the last month. We've seen outperformance out of industrials, out of consumer discretionary, financials, and recently in this last week, healthcare. So those are encouraging signs of the market broadening out that goes a little bit against the narrative of what people are saying.
Yeah, go ahead. I was going to say, I've been looking at tech, which is at, well, if you look at the XLK, that is at a record high. XLI, that's in the industrials at a record high. Right. SMH, that's the chip stocks, that's at a record high. Home builders at a record high. So there's lots happening here that show broad participation in the market.
That's true. I find it helpful to strip out a lot of these large caps and to look at equal weighted indices as opposed to XLK, because that is so much of a concentration in Apple, and Google and Microsoft and this and that. So it makes it interesting to really look at things and how they're starting to show some outperformance.
Yeah. So this is the S&P 500. This is GSPC. That is a purple line. This is the normal market cap weight that you're used to seeing. And then this laggard here is equal weight. And this just shows that the market caps have accounted for a substantial part of the rally this year. But you dial this back to a 2-month chart, it's looking a little bit more even. Well, let's just call that even, up 8% for each of those. And then you take a look at the Dow Industrials versus the transports. Transports much more volatile. They have surged recently. Tell us what you're seeing in terms of Dow theory, or maybe does this extend to this analysis that we're talking about, the market cap versus equal weight? Does this apply to the Dow as well?
Yeah, it's always helpful when you see things like the Dow and the Dow Jones transports join the Nasdaq and moving back above intermediate term swing highs. I mean, the Dow and the transports last week moved to the highest levels in 15 months, and it's been basing for a long time. So these certainly aren't as overbought as things like the Nasdaq, which people are complaining about. Oh, it's too overbought. There are too few stocks carrying the market. I mean, this has been the case for 100 years. You look back 7 years ago, we had the generals, General Motors, General Electric, DuPont. They've always had big percentages of these indicators. So investors have to realize this is not a new normal. If anything, it's an old normal.
I love that. And I'd throw Exxon in there too, if
Right.
you were alive in the 1980s,
That's right.
as I was, but not trading. Mark Newton, thank you for being here. We're going to keep you around, and I'm going to send it back to Julie.
Yeah, and that's the exact description of me as well. Alive in the 1980s, but not trading and not covering trading. Switching gears here and zeroing in a little bit on earnings season, which is kicking into higher gear this week. Investors eagerly awaiting results from big tech stocks. That's after the Nasdaq was dragged down by second quarter results from Tesla and Netflix last week. Tesla's recent pullback overshadows the company's beat on the top and bottom line. And it got downgraded this morning as well over at UBS. So interesting there. We're seeing those shares pull back in pre-market trading. Mark Newton is still with us, Fundstrat Global Advisors, head of technical strategy. Mark, we wanted to sort of dig into some specific names a little bit, and
Great.
Tesla is one of them. Obviously, it is of huge interest to people. So what's the setup look like after what we saw last week?
Well, look, Tesla has had an incredible rise. It's rallied over 100% just since the middle part of April. So it's difficult for stocks to go just in a linear direction straight up without any sort of correction. So it has gotten near-term overbought. There were some instances of the stock price moving up, but momentum has not followed of late. So that's a technical concern that sometimes means that the stock might need to consolidate. So it hit $300, and recently we've seen a little bit of backing and filling in the last week. They've downgraded today. It's down to 256. So it's getting closer to an area where investors might want to consider buying dips technically. But you have to realize that the stock is incredibly volatile compared to many other stocks. I mean, it turned negative last year. Elon Musk sold shares back in October, November. The stock literally got cut in half. It went down to almost 100. And so now here it is at 256. So still, a very, very good rally. And if anything, on an intermediate term basis, it's actually gotten a lot more bullish for between now and 2025, I would argue. But these are just near-term concerns on the stock being downgraded. So I tend to see the stock as short-term negative, but overall on an intermediate-term basis, it's still quite attractive to me.
I'm curious, when you talk about a stock like Tesla that is so volatile,
Right.
and that sort of, one guest we had last week called it a faith-based stock in terms on the part of its investors, is it harder to then do technical analysis on a stock like that, or is it less useful in any way?
No, I would argue the opposite. I mean, technicals really show signs of the stock emerging from breaking down in ways that the fundamentals might not always justify. And so it's really important to study momentum and trend analysis and volume. And this can help to put investors on the right side of where the stock is going to go. I mean, we all hope that the stock was higher in the long run. There's certain times when the technicals line up with the fundamentals. And recently, technicals have started to turn down in the short run. So all of those are important. And Tesla, as you said, it's a stock where everybody has this, they want to invest in a wonderful car and a visionary leader similar to those with Amazon and Apple and the others. And so, sometimes the stock doesn't always reflect what the fundamentals might say. And so that's why technicals are incredibly even more useful during times like this.
And so we heard a lot about the buy on the dip narrative, typically during more of the bullish kind of long-term rallies that we had seen. Are we back in the throes of that right now from your perspective, or is there something else that investors should be looking out for?
With regards to Tesla?
With regards to Tesla or any name that they see a massive pullback or a correction or a dip in to try and get in with that same type of buy on the dip mentality? Well,
buying dips within uptrends is certainly very appropriate and useful. When stocks start to break down to new 52-week lows, oftentimes, investors make a case for value, and the stock price normally has a lot of downside momentum, and it won't always stabilize where fundamentals might justify that it should. And so it's important to take note of stocks starting to break out of longer-term downtrends or breaking down from longer-term uptrends. It really makes a case for studying trend analysis and really helping to take the blindfold off as to how the stock might move compared to the fundamentals.
And I guess the reason why I ask that is because part of this trend, too, has been with a hype phase of AI that's been baked into some of these stocks as well.
100%. Certainly a theme I think will be with us for years to come. Quantum, AI. Look, these are all themes that are wildly bullish probably in the long run, but in the short run, you really have to try to strip the emotion out of the process and realize that stocks can and will get overbought and can correct and sometimes provide opportunities when they pull back. So.
I'm curious about the setup for some of the other large cap tech companies coming into this week. When you look at the likes of an Alphabet or a Meta, as examples, are there any of the big cap techs that stand out for you as having a particularly interesting setup going into earnings?
Most of the large cap technology stocks continue to look very attractive on an intermediate term basis. They really have shown little to no signs of weakness. I would say Netflix is one stock that has started to roll over, but Microsoft remains in great shape. It's recently broken back out to new all-time high territory. So when investors say they want to fade the market or they're worried about stocks rolling over, when you see stocks like Apple or Microsoft at new all-time highs, it really makes it difficult to sell stocks that have just emerged into new all-time high territory. Normally that's a time investors want to be owning those stocks and managing risk, looking for times when that might prove to not be the case. But for the time being, it's still these are still quite bullish names.
Is there a basket of picks that you would look at going into the tech portion of this earnings season and say that's an area of the market that investors just can't live without some type of exposure to in their portfolio?
Well, with regards to technology, you do have to be a little bit more selective after the run-up we've had. Semiconductor names, to me, still look very appealing. They've actually outperformed many parts of tech hardware and software. I would prefer buying some of the stocks that have started to show mean reversion off the bottom, semiconductor names like Intel versus reaching for an NVIDIA at 450. And so some of them are now showing technical signs of being quite overbought and extended in the near term. So it depends on one's time frame and risk tolerance as to whether you buy a stock at new all-time highs or you wait for pullbacks. I like technology. I think it's going to be a driving force for second half gains. I think that interest rates, in my view, are still going to show weakness in the months to come, so that should be supportive of technology. But there are many other areas that are just starting to emerge, and things like healthcare. We're seeing a rotation into more defensive names, and that can be something to pay close attention to.
I want to talk about another area that you recently highlighted in a note, and that's solar, which is interesting to me, saying that you talked about how some of the recent activity in these names has been more constructive. So what is that setup like?
Well, we have seen, the ETF for solar names, the TAN, has broken out of really longer-term downtrends. And the same goes with the energy sector as a whole. But that is more promising to think that we're going to see a better second half and we can see a recovery at a time when people remain very skeptical about energy and its prospects. So, the sector largely has been trending down since last November, and we've literally just emerged. So, for those like myself that look for good risk rewards, energy, in particular solar energy, makes a lot of sense to consider. But you also have to be selective within that group.
Right, I was going to say, is TAN the way to play it, or do you do individual stocks?
First Solar, to me, is the cream of the crop. That is the best stock within solar energy, in my view, of the ones that are large and liquid. Other ones like Enphase Energy or SolarEdge are certainly appealing. They're starting to work as well, but they're just not as strong as First Solar.
Okay, Mark, thanks so much for coming in.
My
lot
pleasure.
Of actionable stuff for people who are watching. Really appreciate it.
Wonderful. Thank you.
Mark Newton is
Great to be here.
Fundstrat Global Advisors, Head of Technical Strategy. Thank you. We want to get a quick check on Domino's, which is getting a boost in early trading after beating the street with second quarter earnings, though it did miss on the top line with revenue at just over $1 billion. The pizza chain earning $3.08 a share in the period. That's just ahead of expectations, although it did have a year-over-year decline in revenue as well as missing that estimate, revenue falling by about 3.8%.
Yeah, same-store sales really only growing about 0.1% during the second quarter of the year. International, that actually grew the 3.6% there, so that worth noting as well. It's always been interesting, too, to see where companies like Domino's are not only having continued relation with their end consumer, which has had a different type of engagement with a company like Domino's, far from the days of just calling up the local pizza chain or the local Domino's in your area and ordering that way. Of course, this one of the companies that have been more digitally minded, and then in recent weeks made a move to get onto one of the third-party delivery apps, recognizing that, hey, we can't just go it alone at this point, and we need that assistance, or at least where the finger click traffic is going towards in the ordering of that pizza process too. So that particularly interesting. But then you think about the other consumer and the franchisee right now, and is there any wavering within that? As of right now, the company has about 2.5 253 gross store openings within this most recent quarter that it mentioned, and then 56 closures during the second quarter of 2023 as well.
Yeah, we talked to Peter Saleh last week of BTIG, who said it's one of his top picks. The stock is sort of meh this year. It's up about 11%. I'm just looking at the S&P Super Composite Restaurant Index, which is up 14%. So it has underperformed its peers. Our Brooke DePalma is going to be listening in to the conference call for Domino's, and she's going to bring us an update with some color from that call.
Absolutely.
Maybe we'll talk pizza, a little more favorite pizza as well. All right, we got much more markets action ahead, including the opening bell. You are watching Yahoo Finance. Does anyone really understand AI?
Well, I'm sure there are experts who do, maybe the ones who are kind of building out the infrastructure. I actually think the whole concept of AI might be overly simplified, and I think there are so many different avenues you can go. Much like the internet, everybody compares it to 20 years ago. Look how many use cases there are for it, and there have been, and then the technologies that have kind of spurred from that. So I think the mistake would be to assume it's just this one monolith that we can kind of copy paste onto everything as a descriptor. There's probably a lot more that comes from it in different industries. And one of the reasons that I don't think AI is just a tech play, I think it's many sectors, actually the beneficiaries of it, that might end up doing a lot better because they can kind of right-size businesses that way.
Mattel stock is on the up this morning after Barbie took the top spot at the North American box office in its opening weekend. It also broke the record for first weekend box office take for a film directed by a woman. In this case, of course, Greta Gerwig. Yahoo Finance's Alexander Canal is here with the numbers, the details for review. She's got it all.
Got
Allie,
it all.
What do you got for
I
us?
was one of many patrons to go see Barbie over the weekend.
Including us.
I know you guys did too, so I'm looking forward to discussing what we think. But Barbie, yes, a really strong performance. It was backed by both Mattel, Warner Brothers Discovery. Both of those stocks are on the move this morning. Barbie nabbed a collective $235 million plus at the box office when you couple that with Oppenheimer, which is a film from Universal. And overall, this was the fourth strongest weekend that we've ever seen in box office history. And it comes at a very critical time when there's a lot going on in the industry. We have those strikes looming. Moody said that theater chains will be hit first the longer the strike continues. So the fact that we had a really strong performance like this is certainly encouraging heading into the fall when we're not going to see as many blockbusters or as many talked about movies like Barbie has. I mean, the marketing here was just insane heading into this weekend.
It absolutely was. I mean, there were a few and we have all seen this. I saw it yesterday, actually, and kind of walked out of the theater just in awe, but also had these kind of takeaways as I thought about it more this morning. One, Barbie core wearing moviegoers, they can have the potential to bump some of those retail sales numbers as well from the fashion and the number of people, yourself, myself, I guess, included.
The Kenough shirt, that apparently is already available.
I know.
You could buy it.
We were looking at it right before the show started. Yes. Also, Mattel. I mean, this is probably a one and done type of box office moment for them. I can't imagine Hot Wheels doing the same type of numbers that Barbie did at the box office. And Hot Wheels is rumored to be in production and be coming out in like 2025 as well here.
I mean, the marriage of Barbie and Greta Gerwig, it does seem difficult that is replicable, right, with other artistic projects, that this was at the same time a commercial and a sort of artistic endeavor. You know, it's a little bit difficult to thread that needle, and the movie did it relatively successfully. We're going to talk with Rick Newman about that a little bit later on. But it's like been percolating through my brain as well as I read too much about it going into it, and my expectations were probably too high. But overall, I did like it. I feel like overall, it tried to do a little too much. I think as I keep thinking through it, there were amazing moments throughout the film. The theme throughout the film was amazing, but I also think it was a very noisy movie. There was just a lot. I mean, it seems like the idea was like, if you had an idea, you put it in the movie, and some of the ideas were spectacular. But at the end of the day, I don't know. It was a little bit noisy.
I agree with that, Julie. I do think there were moments where it was a little too cheesy for me, considering the messaging was so strong. And then, like, spoiler alert, but the Ken dancing musical scene.
That was my favorite.
Okay, no, I feel like for me, I would have been fine. I loved the song.
It had nothing to do with anything.
It had nothing to do with anything.
But it was amazing.
And just to see Ryan Gosling sing, I mean, I think he did such a great job. He was Ken to me, and he's such a big movie star that for a movie star to be able to embody a completely different character like that, I think takes a lot of skill. So I truly enjoyed it. It was entertaining. It was cute. It was fun. Silly at times. I agree with you that there was a lot happening all at once, but the overarching message, I really thought resonated with me.
Barbie as an economic indicator or perhaps a consumer indicator by the time we go into Halloween here. And we're going to bring it back to the figures for the consumer here too. Is this for investors now as we think about it? Is this something that they can continue to ride the wave of? Because if you're going into Halloween and saying, all right, all these people purchase pink, they got to wear it again. And there's going to be so many different
buy more
iterations.
Stuff from
buy
Mattel.
more stuff.
Oh, there's going to be Barbie and Kens all over for Halloween.
And forget about it from the adult perspective.
Yes.
Forgive me, Brad.
Yeah.
But Christmas comes after Halloween, and you can't help but think that there's going to be a bump in Barbie sales of the actual doll as a result of all this.
100%. Yeah, that'll be really interesting to track through the holiday season to see how big of a windfall this is, not just for the box office, but really for Mattel. And we do know that there's going to be other types of movies coming based on their toys. I love the outfits, how they recreated and pointed to the outfits in the movie. I'm sure Rick will talk about this too. It really was a giant commercial.
As we're talking about the kids, one more point. This is not really a movie for little kids, right? I did see some smaller children in the theater, and some of it is a little sophisticated for them, and some will go right over their heads, just for
PG-13.
Parents FYI.
You know, maybe Alan and Midge get a sequel. Who knows?
I mean, Alan,
I know that was perfect. He's just Ken's buddy at the end of the day.
Allie, thank you so much.
You.
We could talk about this for the whole show.
Yes.
All right, but we did just have the opening bell on Wall Street. So, the market store, but we got to check on that.
No pink?
Sponsored by Tasty Trade, not by Mattel. Let's take a look here. All three major averages are in the green to start off this week, and this will be really peak earnings season, right? You're going to hear from so many companies this week, not just big tech, but big industrials like GE coming out this week, big automakers like GM as well. It's going to be a very, very busy week. Oh, and the Fed as well, of course, will be making its decision this week. So as investors look ahead to all of that, a little bit of water treading today, but slightly to the upside. The Nasdaq leading gains with about a 0.5% rise. Brad is back here in the studio, back at the Interactive. So what's going on?
Hi, taking a look at the S&P 500 as you were running through some of the major averages here in the U.S. and that performance to start off a new trading week. And get this, the last full trading week of July. My goodness, are you ready, folks? I'm not. S&P 500, though, that's higher by about 0.4%. Nasdaq Composite, you're seeing that up to start the day and the week by about 0.4%. And the Dow Jones Industrial Average up by about 0.3% here. And so that is good. You've got the trifecta, the hat trick across the board, the triple-double, whatever you want to call it. Nasdaq Composite, let's take a look at that. You've got more green than red here on the day. And taking a look at this is a year-to-date. Yeah, let's take a look at intraday here. I was wondering why we were having such astronomical gains to start the day, and the U.S. major average is not reflecting that. Anyway, neither here nor there. Google, Alphabet, that's up by about 2.25% right now. Apple, off of some news this morning, too, that we'll break down a little bit more for you. You're seeing that up by about 1.4%, and that related to some iPhone production and shipments. And so we'll continue to keep an eye on those. And those are the mega cap tech stocks that we're keeping an eye on. We mentioned Tesla, had full discussion about that with Mark Newton, who joined us earlier in the show. And then let's take a look at some of the 11 S&P 500 sectors. We've got them pulled up here for you on the screen, all green. So we'll not linger on this one for too long, but at least leading the charge right now, you've got communication services up by about 0.8%, trading spots with XLE Energy here as they battle and duke it out for that top spot in the 11 S&P 500 sector performance here. And why not? Because we got some extra time and they haven't told me to wrap yet. Let's take a look at the Dow 30 components as of right now. Looks mostly green here, and I just got the wrap. All right, so bringing up the caboose, you've got American Express, and leading the charge, you have got CVX. That's Chevron.
We're gonna talk about that one in a moment. On the Apple front, the reporting from Bloomberg is that the company is asking its suppliers to hold shipments steady for the iPhone 15 this year at about 85 million units. And so it looks like investors are seeing that as a good sign that despite sort of concerns about recession and the global economy, that they're not pulling back on those shipments. So we'll keep tracking that indeed. We got to stay on the Barbie train for just a little bit longer and ride it to AMC theaters, which are up by about 19.5% today. A couple of things going on. It came out with attendance figures from the weekend, but also, and probably more importantly for investors, the Cinnamon operator was blocked by a Delaware judge from converting its APE preferred shares into common stock. The judge rejected a settlement that would have let the conversion go ahead while also giving out extra stock to account for the dilution of ordinary shareholders. That was in the deal. AMC has now filed a revised deal with the court, citing its urgent need to raise capital. So a couple things going on here. On the attendance front, the company came out this morning and said over 7.8 million moviegoers went to AMC theaters from Thursday to Sunday. That is the best that it has been since pre-pandemic.
Wow.
And that it was also revenue as well, most attendance and revenue in a weekend since 2019. So there's that. But really, that's almost a sideshow to this whole court goings-on back and forth between AMC and the APE shares, which it wants to convert back into regular AMC shares, and it wants to raise capital. but some shareholders had challenged that because they didn't want their shares to be diluted. So that plan is on hold for the moment.
Yeah, that story, as you mentioned, about the share dilution, the more fun story that I guess investors want to pay more attention to this morning, as reflected in the share price reaction that we're seeing. This is up by about 14% right now, is and continues to be about some of the box office performance here too, and where incremental spends within that movie theater experience. I don't think I've had popcorn at a movie theater. It's up 23% now, my goodness. I don't think I've had popcorn in a movie theater since I saw Barbie, and they got me for a couple, drinks, I will say, and beverages and snacks. And so people who are buying into this entire and holistic experience, perhaps boosting those margins a little bit better on overpriced concessions.
Yeah, but I think right now it has more to do with what's going on with this court case, even though it's confusing, to be honest, what's going on here. Because on the one hand, the fact that the dilution is not going to be happening right now would be good news for an AMC shareholder. On the other, when the CEO of the company is saying we urgently need to raise capital, and we can't do it in this way, A, the fact that you need to urgently raise capital is not necessarily a great sign. B, the fact that you can't do it right now in this preferred way is also not a great sign. So it's fascinating to me that the shares are going up. The APE shares, meanwhile, which they want to convert, have been trading at a discount because there have been questions about whether this, and they continue to, there have been a lot of questions about whether this was going to go through. So, there are a lot of questions now about what's going to happen next, and there are sort of two sides within the AMC shareholders now, those who want conversion and those who don't. So this is very much, the movie is not over, shall we say.
Ooh, I like that. Yeah. Now, I mean, look, the APE shares were kind of I dare to say gimmicky, but it was a different type of, it was a gimmicky type of way for them to really kind of annex themselves that much closer to a retail investor that had become a fan of AMC as well, and kind of muddling that together with equity ownership. But at the same time, they had already done roughly, or just south of $2 billion worth of at-the-market equity offerings in 2021 to try and raise capital. So it would have looked like a red flag to investors at a time where it shouldn't have. We knew that they needed to raise capital. At a time where also box office movies still weren't driving people back in droves to that movie theater experience, when we still were at a time period where they were waiting for vaccines to come forward, or at least get the second or third dose to be comfortable going back into those very crowded environments too. So the movie's not over.
The movie's not over.
All right, well, let's talk about Chevron. Movie's not over for them either. Chevron reports better than expected results in a preliminary second quarter earnings release. The oil major, they saw output in the Permian Basin jump to a record, though net income, that dropped to $6 billion. It marks the fourth consecutive quarter of lower results and far from the boom it experienced in the aftermath of Russia's invasion of Ukraine. Chevron also said its CFO will retire next year while waiving the mandatory retirement age for CEO Mike Wirth. Full results will be released this Friday. That worth noting there towards the end is that they came out with preliminary numbers here even ahead of them being scheduled to release results this week.
It's pretty unusual, right? They're scheduled to report on Friday. Not only did they come out with preliminary results, it was on a Sunday. So it's quite unusual here to come out with this kind of thing. But indeed, down year over year, but beating estimates, I guess, is what analysts like. That Permian Basin production is significant. That 772,000 barrels of oil per day coming from Chevron's Permian holdings in West Texas and New Mexico. That seems to be also something that is really helping the shares here. As you saw there, the year to date, the shares are down about 10%, and we really just have seen a flagging of enthusiasm for many of the energy names, Chevron included. And when you look at a 48% drop in profits year over year, you can kind of see why.
All right, year to date, down 10% there, folks. We've got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
Barbie or Oppenheimer?
I gotta say Barbie. I think it's just, it's fascinating when they bring something to life, so to speak. That's been a big part of the culture of the world for a long time. I think it's fascinating to me.
I don't know if we've talked to anyone who said Oppenheimer. Maybe one person.
Maybe one, yeah. It seems, at least in the circles I'm in and the channels I follow, it seems like Barbie's got the upper hand in terms of interest.
Barbie domination.
Domination, absolutely.
This is another big week for earnings. In fact, it's bigger this week, especially in the tech sector. All the big names from Microsoft to Google, as well as companies like Snap, Roku, Intel, they're all set to report. Our next guest thinks that if either Microsoft or Google meets expectations or miss, their stocks are going to be in trouble, similar to what we saw happen to Netflix and Tesla. Let's bring in Tasty Trade CEO Scott Sheridan to discuss. So, Scott, can they not win no matter what? Or do you think there is a scenario where these guys see some upside?
I think they've won. I think everybody's won if you've been long the market. So I think now the time, has come for them to tell their story. And as we saw, obviously, with Tesla and with Netflix, the market didn't like what they saw. But from insane numbers, if you want to, talk about the moves that these stocks have had. So my feeling is that the market is never as good as it looks or is never as bad as it looks. And, right now, I think the path of least resistance clearly for the overall market is the upside. I mean, looking at S&Ps today, again, up, 20. Now they've sold off a little bit, up 15. Market appears to want to drift higher. Unfortunately, for anybody who is long, a down move can come very, very quickly and happen quickly. So even though we've been up, it seems like for the entire year, that can change very quickly. So for the stocks coming out, and this is, basically the Super Bowl of earnings when you look at the companies that are coming out for this week, that these companies, my fear for them is if they don't absolutely crush it, the path of least resistance now is going to be lower just because of the run-up that we've had.
And so in the last earnings season, it seemed like all of these companies could skate by with a mention of artificial intelligence. Is there a magic word or a magic phrase this earnings season, Scott, from your perspective?
Well, AI is a good one. We had blockchain a couple of years ago. It didn't matter what your company did. If you put blockchain into, any earnings report, your stocks seemed to have a favorable push. So
yeah, Long Island was an iced tea company.
Long Island was an iced tea company, and then I think Overstock and Kodak. It really didn't make a difference. So now what's in favor is AI. We'll see. You have Meta coming out with Threads. Is that going to be the Twitter killer? So there's a lot coming out, and I don't want to come off suggesting that I don't want this to appear to think that I think we're going into a crash scenario. I don't think that at all. I just think that where we are right now at 4,600-ish on the S&Ps. It's funny, we're 200 points away from all-time highs, but it doesn't feel like that. When you're listening, people are like, this is a choppy market. My perception, this is not a choppy market. We've just been drifting higher and higher. So are we going to maintain, or is there going to be some sort of, a 5-10% pullback?
So what do you think, Scott? Or do you think we're going to see that pullback?
I think we are going to have a pullback. I do. I think there's too much complacency. It's interesting. You got the Fed coming out, with their 2-day meeting. Chances are they're going to increase a quarter. So what's happening with inflation, though? Inflation numbers seem to be coming down. Chance of recession or a severe recession seems to be coming down significantly. So all of these things are factoring in. When the news starts to get to be really good, which the news does look good, that's the time for me as a contrarian. And I think, most former floor traders are contrarians. I put myself in, that category. I would look at this as an opportunity to lighten up on some longs and perhaps look to get a little bit on the short side.
Scott, when we think about any kind of margin resetting that you believe might be necessary for some of the tech companies that are set to report this week, what type of margin profile for even the largest cloud-based companies or the cloud companies that are set to report should we have in mind going into these reports?
A margin profile.
Margin profile.
Just as you could be.
Yeah, certainly. So for the last couple quarters, we've been watching as growth has started to kind of stall off because corporate spending has been so largely restructured. The margin profile for these cloud companies has shrunk along with that. And so is there a resetting of that you believe is set to come?
I don't. I think that's market forces, but we'll see. It is. I am overall extremely bullish on technology. I think AI is going to be an absolute game changer. Unfortunately, I think we are living in a time when fear is selling, and it doesn't make a difference whether you're talking about politics or you're talking about the stock market. And in particular with AI, I think that there's a lot of people out there who are hawking fear with this. To me, it's just progress, and we need to handle it correctly. Not sure what that means, what type of restrictions. Self-policing, I don't know if that will work. Obviously, there will be some bad actors that try to leverage AI, in their favor. But for me, it's going to be a net positive over the next, 5, 10, 15 years.
Scott, do you have a favorite tech trade going into earnings?
I would take advantage of selling volatility going into earnings. That would be my trade.
All right, Scott Sheridan, thanks so much. Good to see you, Tasty Trade CEO. We got
My
much
pleasure.
more.
Have a good day.
Thanks, you too. Much more markets action coming up. Stay tuned. You're watching Yahoo Finance. What is the best piece of career advice you've ever gotten?
I think the best advice would be not as much figure out what you're good at, but figure out what you're not good at and what you don't like. Because we're pretty good at figuring out, what we like to do on a day-to-day basis. But when you're put into a job where every day you're doing something that you really don't like and you really can't stand, I think that kind of starts to eat away a little bit. So I would actually say, someone who told me a long time ago, figure out what it is that you don't like to do. Try to, find that, whether it's in an interview or kind of the first stages of getting to know a company. That's probably going to help you out longer term.
Elon Musk making headlines again after changing the globally recognized Twitter logo from the blue bird. Musk sent out a tweet yesterday saying, "Soon we shall bid adieu to the Twitter brand and gradually all the birds," before the logo changed to a black and white X earlier this morning. So the latest change he's trying to make in his efforts to eventually have a super app, which kind of harkens back to his X.com precursor to PayPal company. And so, indeed, if you go to Twitter, you'll see the X instead of the bird this morning.
You know what's more interesting, too, now? For a while, if you went to x.com, it would still be like a page loading, or it just would be blank or something coming soon. Now, if you Google or if you just look up x.com or enter that into your search query, redirects you to Twitter.
I mean, by the same token, you know, it was interesting. The Twitter CEO, Linda Yaccarino, tweeted, "It's an exceptionally rare thing in life or in business that you get a second chance to make another big impression."
Yeah.
But when something like the Twitter brand is already such a strong brand, it's difficult to see I'm going to go X.
Yeah.
Like if you're posting,
You're just posting
You're not going
at
to
this
say you're going to say I'm going to go tweet.
Right.
I'm going to go to Twitter. I sent a tweet. It's difficult to see, you don't get another chance to make a first impression, but you also, I don't know that they really are getting another chance to make a first impression. We still Google things.
Right.
We still go on Facebook.
Yeah.
You know, despite Meta changing its name, its corporate name, I just think it's not as easy as we're changing it, and that's gonna change the actual image and brand.
And I guess that's the strategic elements that all of these companies have employed in one way or another with a super umbrella type of company, because for Alphabet, that's how they decided to do it. They said, yeah, we still have Google. There's still brand equity in Google. There's still brand equity in YouTube. But at the same time, this is now the parent company that all of this funnels underneath of. Same thing with Meta platforms. Still got Instagram and WhatsApp, Messenger, and Facebook go on. But now this gives us opportunity to branch out and have the metaverse. And so where X can mean anything, if you're thinking of mathematical formulas out there or algebraic formulas, perhaps that's where Elon Musk is leaning, where X could be your car, X could be your social media experience.
But this is a different approach, though, where they are actually putting the X brand on the site.
Yeah.
Of those different examples.
And first time getting a glimpse of, how quickly they actually wanted to make X something that was immediately recognizable to consumers, even before all of that being a reality too. Because the metaverse is not a reality, but we know about Meta well before us even having an avatar or a metatar that lives in that different reality, or I don't know. I don't know what they're called.
You
I
know
just know
what?
they have
All
no
I can
legs.
think of is stop trying to make X happen.
Ooh. Deep Mean Girls reference there. I love it.
Not that deep, but
not that deep. It's pretty high. It's pretty high up there. All right, anyway, all your markets action straight ahead, plus more Mean Girls references. You're watching Yahoo Finance.
Where will CPI be a year from now?
Well, I think if we were going to almost play the game of base effects, like CPI was flatter this June because of last year, we hit the peak. Maybe a bit higher if you get a bit of a stabilization in commodity prices and energy prices, and then you don't get as much relief on some of the stickier parts of inflation. But I think for the most part, hopefully we'd be stabilizing, but we haven't been focusing on that as much, and as you and I have talked about a lot, the Fed hasn't been focused on that either. They've been focused on other metrics that have been a little bit slower moving to the downside. So I think it ultimately depends, in my view, on the labor market, how strong wage growth is. If we do start to see a little bit of a loosening, if you don't, you probably have a scenario where you're a little bit of a higher inflation plane.
Welcome back, everyone. Just after 10 a.m. in New York City, this is Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman. We're about 30 minutes into trading, about 32 here on the session, and let's take a look at how stocks are moving this morning. First, stocks nudging higher as 150 companies on the S&P 500, they are on deck to report quarterly results this week. Investors also focusing in on the Fed, with most economists expecting a 25 basis point rate hike for the July meeting.
Meanwhile, Mattel shares riding higher after Barbie wins the box office battle in its opening weekend, facing off against Christopher Nolan's Oppenheimer. It was never really a contest here. Barbie buzz working its magic. It was always going to be the winner, bringing in $150 million over the 3-day haul.
Yes, we are all hot pink this morning. And Tesla shares skidding into the red, not hot pink, after UBS downgrades the stock to underweight from neutral. The firm citing the stock's recent rally, leaving limited upside risk to near-term earnings here. UBS noting that it continues to see Tesla globally leading the race to affordable electric and autonomous mobility.
And Apple shares are in the green, not by much though, coming off of some recent gains after the open. Reports suggesting it is aiming to keep iPhone shipments steady at around 85 million units this year. That's according to Bloomberg. That number would fall roughly in line with last year's level. Well, traders and us, we have a busy week ahead with plenty to digest. From earnings results to new economic data and the Fed, Yahoo Finance's Josh Schaefer is here too. You're going to do it like, I don't know, speed talk style, because that's the only way to get it all in.
Julie, we do the calendar every Monday morning.
Yes, we do.
This is by far my favorite calendar we've had in the last couple of months. It is very full. It is very exciting. We're starting with the economic data that we have this week. We had those PMIs already come out this morning. You actually saw a little bit of an uptick in manufacturing PMI and a downtick in services PMI, which is against the trends that we have been following. So it'll be interesting to see what economists have to say about that. We're going to get 2 more looks at consumer confidence, or the overall feeling of the consumer, I should say. We have consumer confidence, that's from the conference board on Tuesday, and consumer sentiment from the University of Michigan on Friday. Remember, that last print of consumer sentiment we saw a big uptick in how consumers are feeling about the economy. It'll be interesting to see if we see that as well. Now, I did sort of bury the lead here. Wednesday, we have that Federal Reserve decision, or rate decision. I did kind of bury it because it is largely already priced in that we are probably going to see a 25 basis point rate hike. But it'll be interesting, of course, to hear the commentary from Jerome Powell and what he says about a lot of the other things that are on this calendar, what he says about the labor market, what he says about inflation. And I should add, we're going to get another update on inflation and the Fed's preferred target, or preferred inflation measure, I should say, the PCE index on Friday. That's just on economic data.
That's cool. Yeah, let's talk about some earnings that are coming out, though.
This will be more fun, right?
Yeah,
I think the earnings calendar is normally more fun, and it's very crowded this week. We have over 150 S&P 500 companies reporting earnings this week. It really kicks off tomorrow in large part with that earnings calendar coming up this week. You'll know that we'll have big tech reporting this week. You have Meta reporting. You also have Alphabet, Microsoft. So there you see it right there. That Tuesday calendar really kicks off with Microsoft and Alphabet. You have Meta reporting on Wednesday, and I think it's going to be interesting to see a couple things. You'll see how that AI rally reacts. You'll see what the advertising market is like. You'll also see that when Roku reports on Thursday. And then you're going to see what cloud infrastructure is like as well when you think about Microsoft and Alphabet. And then, of course, we'll have some state of the consumer kind of food stocks to take a look at, too. When you think about Chipotle, Coca-Cola, McDonald's, and even Sweetgreen is in there, I think, at some point this week as well. Now, Julie, I updated our earnings report card for you to also have revenue.
Ooh, exciting.
So we got to take a look at that as well. So this is how companies are doing to start the year through earnings. So 75% of companies are beating EPS estimates. That is actually below the 5-year average, so coming in a little bit lower than it normally does. But when you take a look at revenue, this is what it seems like stocks have really been trading on a lot this earnings season as well. 61% of companies have beaten on revenue estimates. That is below the 5-year average. That is below the 10-year average. And again, stocks have been moving a lot more on that revenue number, that top line number. But we'll see what happens this week. 166 companies from the S&P 500 report earnings. So we will have a much better look at these two numbers here and really how stocks are doing when I come back next Monday.
If we want to get really fancy, then we would say how many companies are beating the look ahead for the year forecast.
The forecast?
Yeah.
All right, I got something to do this week.
Yeah.
Yeah.
I won't be busy with the calendar, so I got something to
No,
do.
I know.
I'll take
You
a look at
don't
that.
you don't have anything to do this week.
Right.
So, Josh, thank you so much.
love homework.
Appreciate it. Well, Jay Powell's going to take center stage once again to report the latest Fed policy decision in July. This comes after officials decided to pause rate hikes in last month's meeting. Most economists expect rates to rise another 25 basis points or a quarter point, while the Fed last month pointed to 2 more potential rate hikes this year. Here to discuss the latest in the landscape for financial conditions, we have Vincent Reinhart, Dreyfus and Mellon chief economist. Vince, I love that you led your note with a Yoda reference and talked about 2 more increases coming. Is that still the base case here, is that this is not going to be the last rate increase that we will get?
So I wouldn't say they paused the rate hike in June. They pared the rate hike in June. They've slowed the pace of tightening from 75 to 50 to 25, now to 12.5 basis points per meeting. The way you do 12.5 basis points a meeting is you skip one, then you tighten by 25. June was the skip. July is the sure delivery of 25 basis points. That's why everybody universally has the expectation of tightening. What do they do after that? Well, if they're parent meetings, then we're not talking about the meeting after this one. We're talking about the next 2, September and November. November is a long way away. I'm not so sure they'll actually deliver another quarter point hike. It's going to depend on the data. It's going to depend on what Jay Powell says at Jackson Hole at the end of August. And we'll get a little hint of that in the press conference on Wednesday.
And so even as we kind of look through the data and where we're already starting to see some cracks as a result of either Fed policy or just as a result of this being expected while they're cracking down on inflation, where are we seeing some of those weak spots right now as the Fed is evaluating it?
Well, the data are mixed. We got a little bit of a confusion on the PMIs, as you noted earlier. Manufacturing has tended to slow more. We already got a housing recession. That's about higher interest rates and Federal Reserve restraint. What's in the works is the constriction of bank balance sheets. Deposits are off about 5% on a 12-month basis. Lending growth has stopped. It's coming to the point where it'll be contracting soon. The securities portfolios on banks are already contracting. So the next leg of Fed monetary policy or restraint goes from prices, interest rates higher, to quantities, bank balance sheets tighter. And that's what comes next. And it'll be reinforced because quantitative tightening really is going to be getting some traction over the next 6 months.
So let's talk a little bit more about quantitative tightening and how much it then sort of magnifies and extends the rate hikes that have already been enacted, right? So does that mean that in some measure we are sort of underestimating the effect of tightening because we're not taking into account enough the quantitative tightening that's happening?
I think that's exactly right. That's why I worry about recession, not that the yield curve is inverted. It's been inverted for a real long time. Jay Powell worries about restriction, but it's as a result of the bank run. I think it's might be about the Federal Reserve's balance sheet. In full disclosure, wrote a couple papers with then Governor Ben Bernanke 20 years ago about unconventional policy. And the one thing we noted is quantitative action is hard to quantify. One way is, what are you doing to the size of the Fed's balance sheet? And in the first year of quantitative tightening, QT, the Fed sold off $750 billion worth of its securities. Well, it let them redeem at auctions at maturity. So they left the Fed balance sheet. Do you know how the Treasury paid for that $750 billion of redeeming securities? It ran down its deposit at the Fed because it was worried about the debt ceiling. That is, the Treasury paid the Fed with the Fed's own money. It had no consequence for the private sector. Now that the debt ceiling is suspended, The Treasury isn't running down its cash balance, it's actually building it up. The Fed quantitative tightening will actually be shrinking the assets available to the private sector. That's going to be getting traction in markets. It's going to be a source of deleveraging and constraint on credit.
And will we actually see a quantifiable sort of GDP knock-on effect from that, Vince?
Don't know. It's a great case study. It's hard to assess the effects of the Fed's balance sheet on economic activity. But if there are any, we're going to see it in the next 6 months, because we're going to go from a situation of the first year in quantitative tightening when it did nothing to the next 6 months of quantitative tightening when it's a significant restriction on the private sector. Do I think it'll have an effect on GDP? Yeah, it's part of the reason I think we'll be in recession at the turn of the year.
So what does that signal to you, or what does that mean to you as we're looking at this kind of next leg of Fed policy now shifting to quantities? What does that mean or spell out for some of the areas of stickier inflation, whether that be home prices or some of the larger purchases or services related?
So the bad news is it means that the Fed is probably done after its action this week. It'll tighten a quarter point more, deliver that 12.5 basis points of tightening per meeting. But by the time November comes around, the economy will have slowed appreciably. Inflation will be a little bit closer to the Fed's goal. It won't be there exactly because of the sluggish, sticky stuff that you mentioned. And we'll wind up in a situation in which the Fed stops tightening, holds the funds rate at the prevailing level of 5.25%, and ultimately gives up before inflation gets back to 2%. So ask me, where's inflation a year from now? Probably something like close to 2.5%. Above the Fed's goal, but the Fed's going to say close enough for government work.
All right, we'll see how it ends up playing out. Vincent Reinhart, good to see you as always. Thank you so much for your perspective on this, obviously very deep perspective on this. Dreyfus and Mellon chief economist, thank you. All your markets action coming up. You're watching Yahoo Finance. Is there a topic or skill or anything that you wish you knew more about, that you're slightly embarrassed that you don't know more about?
I will say getting around the city in terms of directions.
Really?
There are certain parts of the city where if you go downtown, everything gets tougher because there's no more of the grid.
Right. How long have you lived here?
I lived here for 4 years. It's a bit embarrassing.
Oh,
I know.
Kevin.
I got to figure, and I live downtown. So I'm trying to get better at memorizing names.
And where are you
streets.
from?
From Chicago originally.
Okay. Yeah, I guess Chicago is a little more
It's a little bit more of a grid the whole time. Once you get in the suburbs, you're driving, so it's a bit different. But here, I wish I had a better map of how, once you get, I guess, below 14th, things start to change.
Stick with me, kid. I'll show you.
Sounds good.
Let's do a check on the market sponsored by Tasty Trade. We've given up some of the early gains, or at least kind of flipped them, whereas the Nasdaq was earlier up 0.5%. Now that goes to the Dow. The S&P hovering in the middle here as investors await a lot of data and earnings over the course of the week. In the meantime, key economic data is already out of Germany and France, and it came in much softer than expected, sending the euro slumping this morning ahead of a week packed with central bank decisions, not just from the Fed. The Federal Reserve does announce its latest rate decision on Wednesday, and then we get the European Central Bank on Thursday. A year after the ECB began raising rates, policymakers are set to unveil another quarter-point increase. Joining us now to break it all down and where you should put your money accordingly, Laura Cooper, BlackRock Senior Macro Strategist for iShares EMEA. Laura, glad you got the color memo here this morning. Good to see you. So I specifically want to zero in on Europe first, because we did get this disappointing data, and it really feels like more than it has been that we're seeing this sort of two-track situation between the U.S. and Europe. What's your current thinking on that region?
I think certainly the data this morning did surprise to the downside, and most evident is that we are seeing this ongoing weakness in the manufacturing sector start to spill into the services sector. And probably what was most worrisome is the fact that those key leading economic gauges like new orders, expectations for output, hiring, all fell quite sharply, which does suggest the European economy is set for a contraction by the end of this quarter, which is a divergence from what we are seeing in the US, where economic activity continues to be quite resilient.
And so, Laura, as we think about how this is also going to kind of continue to set the tone for where recoveries for the companies that we're monitoring this week that are intertwined with some of those international markets, what that continues to look like. Is there anything that would show up within earnings this week that could be tied to what the environment is in some of those international markets for the propensity of the consumer to spend and where they are still wavering through their own inflationary pressures?
Well, I think crucially, it's all about kind of the health of the consumer. In Europe, the consumer has actually been fairly resilient, despite the fact that we have actually seen negative real wage growth. So if we start to see some signs of that pressure come through in that sector, we do expect that's going to fill into more of those cyclical earnings backdrop. But again, it's all about what's priced in already. And if we look about earnings estimates for the next 12 months, notably energy, that's really a key area where we think a lot of the economic damage is already in the price. So there could potentially be cyclical opportunities in very select parts of the market.
That's quite interesting. I'm also curious, as we look between Europe and the UK, whether how you're sort of weighing those two opportunities, whether the UK has any opportunities right now.
I think the UK backdrop from an economic perspective is much more challenged, despite the deterioration in data that we are seeing come through from the European continent. And this is largely reflective of this divergence that we are seeing in price pressures. So core inflation in the UK does remain stickier and more problematic, which does suggest that the Bank of England has more work ahead of them in terms of tightening policy to try to curtail some of those price pressures. Where in the ECB, we do expect they're probably near the end of their tightening cycle. Yes, we are seeing inflation still remain above that 2% target, but they're likely going to focus more on the growth backdrop. So from an investing perspective, we do think that there's more attractive opportunities in the European equity space and the European government bond space, rather than looking at UK-specific exposures.
To what extent, and I know you cover EMEA, but to what extent are you also looking across the Asia-Pacific region and considering the inflation, or at least the prints that we're getting from Japan out right now, too?
Well, we did think that the Bank of Japan meeting this week would potentially be a bit of a surprise to the markets, but we have seen consensus shift materially in the sense that most analysts don't expect any change to yield curve control. This is on the back of recent Bank of Japan comments that suggest that inflation is really not yet seeing signs of being sustainable. So there is, of course, this risk that we could see a kind of a shock move later this week, but that's not our expectation. So we do think that this monetary policy divergence will continue to persist between a lot of the other developed markets and Japan. And it's one of the reasons why we do like attractive exposures in Japanese equities. But again, we are really thinking more about kind of taking on the defensive quality tilt within the US and within Europe is probably a bit more attractive at the entry points right now.
So, Laura, where do you feel like then globally you want to take on a little more risk? Are there places where that is more appropriate right now?
Well, I think the key question that we've been asked is we've seen this tech-fueled rally in the US on the back of this secular wave of AI, and that could be challenged this week if we do see those earnings reports come through not really being backed by kind of the fundamentals around profitability. So we're questioning the sustainability of that rally in the near term, but it is opening up pockets of opportunity in some cyclical components of the market. As I mentioned, energy, we do think that's, a lot of the damage is in the price there. But overall, we're taking this defensive quality approach, continuing to seek those exposures where we aren't seeing that margin compression, where we do see demand resilience. But crucially, I think forward guidance in earnings season will be one to watch to really decipher where those key divergences are coming out and where those tactical alpha generating opportunities lie.
Perhaps you could break that down just a little bit more for us. Demand resilience without margin compression and how you look at it from your perspective.
I think the key sector that comes to mind is around healthcare, and healthcare in Europe in particular. It does tend to be a defensive sector. It does have that inelastic demand. We are still seeing some signs of that pent-up demand from COVID, but as well, it's going to benefit from the long-term trend around aging demographics. So that's one area that we do like to take opportunities in. And then I guess thinking more regionally in light of today's data, we do think that periphery equities across Europe, so Italy, for example, Spain, have actually been strong performers year to date. And we do think there is further scope for upside given their sector composition. So tourism exports did come under pressure in today's PMI data, but we do think there's enough demand there to support that key areas of these equity markets. And as well, industrials and the luxury sectors in France in particular. Industrials have actually been fairly resilient despite the contraction that we have seen in manufacturing. And we think this accelerating destocking of inventories is probably reaching an inflection point. So we are going to see an inventory build that's going to provide a tailwind to industrials. So we do like that composition in France in particular as well.
Laura Cooper, BlackRock's senior macro strategist for iShares EMEA. Thank you so much for joining us.
Thank you.
Thanks. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. The White House is cracking down on AI safety. The Biden administration announced 7 companies leading the charge in AI. They have signed an agreement and a commitment to ensure safety and transparency around the technology. The White House also said it's in the midst of developing an executive order around artificial intelligence, but has not released a timeline. Our 3 to 5 p.m. team spoke with Nick Clegg, Meta's president of global affairs, about the development of AI, and here is what he had to say.
It's moving very fast, and like with every kind of fast-moving technology, which is the technology is bigger than any single company or indeed any single country, there's always legitimate questions about how to strike the right balance between moving fast with these innovations but doing so responsibly. And I think all of the companies, including Meta, we kind of agree with that. We want to strike the right balance about moving forward. These US companies have a real role of world leadership in this technology, but to do so in a way that people feel is transparent, so people can see for themselves how these systems work.
For more on this, we're joined by Ashley Gold, Axios technology reporter. Ashley, great to speak with you this morning on this. You've been reporting on this as well. And so with regard to the timeline as to when we could see perhaps even an executive order come through, is there any more clarity around that at this point?
No, there's no more clarity on that at this point. But if I had to guess, I think they would want to get something out maybe during the August recess before Congress really gets started again this fall. Senate Majority Leader Chuck Schumer has his own plans for legislating on AI, and I know the White House wants to both coordinate with Congress, but also seems like they really want to seem like they're ahead of the game on regulating AI.
And so what does that entail, Ashley, I guess is the question, right? It's a question for them, it's a question for us, it's a question for the companies that are involved, but as this dialogue's going on, are things sort of coalescing around a certain set of priorities?
There are many different ideas sort of being thrown at the wall right now. You see members of Congress introducing bills that would, create regulatory agencies just for AI and digital platforms. You have draft bills in the works that would require AI systems to be certified and to be subject to fines if they don't, abide by certain rules. There are a lot of ideas floating around. What everybody is sort of coalescing around is this idea that the risk of the AI system should determine how much regulation goes with it, and the size of the company should also help determine what level of regulation it gets. But as far as hard and fast things that everybody is agreeing on, other than wanting to strike the right balance, which we hear all the time, there's not a ton of really clear agreement yet.
These companies, some of them are going to be reporting earnings this week, and we've been discussing that at length this morning without getting too much into the numbers, but perhaps the tenor of what they have to say around where they would like to see regulation move forward within AI and how that could impact their business. I imagine you've had some conversations with them as well to that extent. What are they saying about what regulation they would like to see and perhaps even what timeline they would like to see that on?
So I think that they all want to see regulation because right now there's a lot of uncertainty. And if there, was definite regulation coming down the pike that they could plan for, that would create a lot more clarity within the business. They could plan for it. They could, set aside the funds for it. Right now, they have no idea how much this is going to cost them. I mean, compliance with the major tech rules in Europe, the DMA and the DSA, that's costing companies a lot of money. So I think especially for smaller AI companies, that's something that they want to, sort of be able to take into account immediately before it chips too much into their revenue.
I mean, of course, at the same time that they're doing this, they're really pushing into AI, right? We're coming into a week where we're going to hear from Microsoft, we're going to hear from Alphabet, and undoubtedly, a lot of the discussion is going to revolve around AI. One has to wonder, too, I mean, it seems like for investors, regulation isn't as much on their radar at this point. They just want to hear push, push, push.
Yeah, absolutely. I mean, part of this is the tech industry just having learned a very big lesson after social media started to get a lot of pushback and lawmakers called for regulation. They saw how that game was played. It didn't go great for Meta and YouTube and Twitter and Snap and TikTok. And they're getting out ahead of it. They know there's going to be calls for regulation, so they want to be part of it from the beginning so they can really have a major role played in what it ends up looking like. So they're being strategic here and trying to make sure those Washington relationships are sort of positive from the get-go.
Certainly. Okay, so now going forward from here, is it clear that Congress has a clear understanding about artificial intelligence, the ramifications? I mean, because that's where there has been that lag for any type of technology, whether it's cryptocurrency or blockchain or whether it's some other form of social media that they've had to evaluate in recent years. There seems to be that knowledge gap and trying to get up to speed very quickly. Have they been able to do that around artificial intelligence to this point?
So they're definitely working on it. I know Senate Majority Leader Chuck Schumer wants lawmakers to feel really educated on this topic. That's why he's been having senator-level briefings with experts for the past couple of months. And in the fall, he's kicking off a series of roundtables that will be not open to the public the way a hearing would be, where you hear from a bunch of witnesses and then you have to worry about looking a little silly when you ask a technical question. These are going to be more casual for lawmakers to ask questions, feel comfortable, and really get read up on it. Of course, they're not going to be AI experts within a couple of months, but there's a pretty concerted effort to get lawmakers read in on this to the extent that they can.
Yeah, that's always at least good for some comic relief, right? When we watch these hearings sometimes and some of the commentary that they make, which we'll all be watching. Ashley, good to see you. Thanks so much. Ashley Gold, Axios technology reporter. Appreciate it.
Thank you.
We got much more coming up. You're watching Yahoo Finance. Barbie or Oppenheimer?
I gotta say Barbie. I think it's just, it's fascinating when they bring something to life, so to speak. That's been a big part of the culture of the world for a long time. I think it's fascinating to me.
I don't know if we've talked to anyone who said Oppenheimer. Maybe one person.
Maybe one, yeah. It seems, at least in the circles I'm in and the channels I follow, it seems like Barbie's got the upper hand in terms of interest.
Barbie domination.
Domination, absolutely.
Domino is out with mixed results in its latest quarter. The pizza chain beating earnings estimates, yet revenue came in short of estimates. Shares are rising this morning. Here with the latest on what execs had to say on the quarter, we've got Yahoo Finance's Brooke DePalma. Brooke, so what they have to say?
Well, first of all, the call started at 8:30. Typically, the call starts at 10:30, so it was an early start to our Monday morning here at Yahoo Finance. But really, CEO Russell Weiner focusing in on more rewards for customers, more innovation, leading to more sales in carryout and delivery, and of course, that partnership with Uber Eats was a pretty big topic of discussion there. Diving in further to the takeaways, the company relaunching their rewards app this fall. They said that will actually bring in a big influx of new customers there who can redeem points at various levels. Right now, that lowest range is 60 points. They also emphasize that knowing that a carry-out customer's tickets typically trends lower, they'll have a lower hurdle to get points. And they're saying that this new reward system will indeed drive profitability, tech and product innovation, and ongoing emphasis for Domino's. They recently introduced, of course, that pinpoint delivery, allowing you to get pizza whenever you want. They also are introducing pepperoni stuffed cheesy bread, which they hope drives sales as well. And of course, that major partnership with Uber Eats, a big topic on the call this morning. We now know that that 12-month partnership exclusively with Uber Eats is set to launch in 4 pilot markets, and it's expected to reach markets across the country by the end of 2023. On the call, CEO Russell Weiner gave us some insight on how and why the company decided to launch with Uber Eats. Take a listen.
By participating in the aggregator marketplace, we'll drive net incremental orders over the long term by tapping into a new group of consumers. In addition, our contractual agreement has secured the protections that we require to maintain control over our customer data and assess the incrementality of the platform. Now, most importantly, orders placed through the Uber Eats platform will be delivered by Domino's delivery experts.
Now, Domino said that they currently don't have the staffing in order to meet this incremental volume that they're expecting from this partnership. They also emphasize that who exactly is that audience? Well, given that Uber Eats is a higher end marketplace, they do expect a higher income audience from there. And as far as where exactly customers can look for value, they said still on their Domino's website and on the app is where they're going to sharing the most value, bang for your buck on the app. So continue to look there despite this partnership.
Okay, so all about the Uber Eats partnership, the demand that they're seeing. Let's talk about margins and inflation. Right. Their input costs. What's happening there?
Yeah, well, certainly food continues to be a major cost for the company. And of course, flour, cheese, things that we've seen trend higher over the past year continue to weigh. And because of ultimately those higher prices, we did see a weigh on demand this quarter. They did miss on revenue. But ultimately, across the U.S. system this quarter, we saw menu price increases of 3.9%. Once again, that weighing on customer demand. They said that they do expect average pricing to be similar this upcoming third quarter. They do expect it to moderate, though, in the fourth quarter, normalize a bit there to 2%. But now the company expects ultimately to see more deflation as far as food costs in this upcoming later on this year in their food basket. They expect that in turn to provide a boost to franchisees. CFO Sandeep Reddy shared more on the call. Take a listen here.
If the current level of food basket deflation that happened in Q2 continues, it's mostly driven by cheese, by the way, we should continue to see material upside on the food basket as we go through the balance of the year. This makes a huge difference to profitability of our franchisees, and I think that helps repair some of the pressure that they took last year in their profitability.
Now, many analysts are really focusing here on these cost improvement that are set to happen later on this year. In addition to that, they're really hoping that these top line drivers, this Uber Eats profitability, this ongoing innovation really will ultimately lead to growth for the company. And of course, Domino is a pizza delivery company or a tech company. They're really honing in on getting more customers through their door.
And paying less for cheese,
exactly.
I guess, as he was just saying. High cheese costs. Thanks so much, Brooke. Appreciate it. Our Brooke DePalma. Well, speaking of what's been happening in the commodity markets with input costs, we did see soft commodity prices jumping last week after Russia pulled out of a crucial deal allowing the export of grain through the Black Sea. Corn and wheat spiked in particular as markets tried to decipher what Moscow's withdrawal means for global supplies. Our next guest says commodity markets are now focused on war and weather. with uncertainty over shipping in the Black Sea putting all investors on edge. Joining us now, Sal Gilberti, Teucrium Funds Chief Executive Officer and President. Sal, it is great to see you once again. So the dynamics, I guess, first of all, tell us what has changed in the past year or so when it comes to these dynamics, or is it just sort of more of the same and emphasized in certain areas?
Well, good morning, Julie. Good to see you as well. What's changed is that we had, after last year's initial price burst, because everybody basically priced in a worst case scenario of exports out of the Black Sea stopping, we had the grain deal, and we had a pretty good year of a lot of grain moving out of the Black Sea and moving out of the Ukraine. And now we're kind of back to where we were last year, in that we're approaching those old highs. We're approaching that same fear level that the market is trying to price in essence, a loss of all exports from Ukraine. That's what the market's pricing in right now. And that's an adjustment. So Russia's turned up the heat. That's a bigger deal than people might think. I think people and the markets have grown complacent over the past 6 or 8 months. And we're kind of back to where we were a year ago, where we have heightened fears of supply disruptions and commodity inflation.
Sal, I think about the weather right now as well as one of the impacts on commodities too. I mean, we've seen some of the hottest days that Earth has ever seen in this year and early in this summer as well. So how has that impacted some of the commodities landscape, mostly in looking through your notes here as well, mostly as we're kind of correlating this to crop production?
Sure. Well, it matters how hot it is where they grow crops. So the world can be hot in some places, cool in other places. All that matters to a farmer is what the weather is over his field, his or her field. And so what we've seen is China actually has seen a lot of heat this year. They had too much rain a couple of years ago, which literally started the grain rally. This year, they've got a lot of heat coming in, and there are worries about China's grain crops, particularly their rice and their wheat. India has enormous issues, and it fluctuates between too much heat and too much rain. But they have huge issues, and they've actually banned about half their rice exports, and they are the world's largest rice exporter. So we had very big drought in Argentina, which affected wheat exports and soybean exports this year. And right now, the U.S. has started off with a really dry spring. The corn conditions are unknown. We hope that they improve because it has started raining the past couple of weeks here. Wheat is pretty sad condition in the United States, but there's plenty of wheat elsewhere, especially in Russia. So weather's a huge factor here. As the earth warms, interestingly enough, it's good for crops because warm air holds more moisture and you get more rain, but it's all locational. It depends where it's hot and where it's dry.
And Sal, the agricultural industry has also made enormous technological strides, to try to deal with some of this changing climate. Is that going to result in some point in a more even smoothing out of supply and smoothing out of prices, or are we a long, long way away from that?
I think we're a long way away from that. There have been some good genetically modified engineering improvements, especially for corn growing in heat and corn growing in all crops growing in dryness. And so a lot of companies work on that. It's really important, and they are making progress. But that takes a long while, and you have real life events like a war in the Black Sea that can disrupt even the greatest technological advances in growing.
Wow. Okay. And so, one of the other things that you mentioned in your note that I really kind of latched onto here was also how Brazil is now the most important country for corn, soybean, global export markets as well. Can you just break that down a little bit further for us?
Sure. Brazil has a lot of space, and they are filling it quickly with cropland. And they have overtaken the United States now in both markets. A couple of years ago, they overtook us as the leader in soybean exports. The United States was always number one. Now it's Brazil. And Brazil grows and exports more soybeans than the United States right now. Now they've taken over as corn. So Brazil has a longer growing season than we do. They can plant soybeans and then plant corn after that in the same season. So they have an advantage geographically, and they have become the dominant force. let's not diminish the United States' power in the soybean and corn markets, but Brazil is basically filling the gap. The United States has a drought, some kind of effect that we'll end up seeing what the conditions of our crops are in a couple of more weeks and months here. But Brazil can fill the void. Brazil can fill the void for soybeans and corn. Russia can fill the void for wheat. So long as exports remain, the export corridor in the Black Sea remains open to Russia as well.
Sal Goberti, who is the Tukrium Fund's Chief Executive Officer and President. Great to always get some of your insights and perspective. Really appreciate it.
My pleasure.
All your markets action straight ahead. Everyone, stay tuned. You're watching Yahoo Finance. Okay, but back to Barbie. Barbie made its big screen debut with a smash this weekend, raking in $155 million in North American ticket sales. Julie and I saw the film this weekend, and so did Yahoo Finance's Rick Newman, who joins us now.
Oh! Wow!
Rick, I didn't see it coming. Came through with the pink, the hot pink. Rick, give us your take.
I mean, I'm trying to join in the fun, but I have to say, guys, after I left the theater, I felt like I just sat through a 2-hour Barbie rebranding exercise. I feel like this was I mean, it was fun, but I feel like it was a commercial for Mattel. I mean, they are updating Barbie for the meme era. The breaking news about Barbie is that she is now self-aware. You know, this is part of the whole evolution of Barbie. She started as basically a supermodel doll for girls. Mattel updated her over the years. There's now a lineup of diverse Barbies. There's a lineup of inspiring Barbies who are high achievers. And it feels to me like Mattel, which was a partner in the film, basically said we need to go further with Barbie. So let's see if we can get this cast of all-stars, a lot of eye candy on the screen, and of course the great director Greta Gerwig to bring Barbie into 2023. So I thought it was a pretty decent film, but I think as a rebranding exercise, it's brilliant. I mean, look at how successful it is. I mean, record box office, everybody's joining in. I'm here trying to join in the fun. But is it a great film? I don't think so.
Wow. So, okay, so here's what I would say. I had my takeaways as well from the movie. I think is it a great film? I don't know. It's a very good film with moments of greatness, certainly. And I think that especially it's so American, isn't it, that we have commerce and art here coexisting, because I do think that this is a work of art at the same time that indeed it is a Barbie rebranding and a Barbie sales pitch. And on that point, go to my third takeaway here, which is brace for Barbie holiday domination. We were talking earlier about this. Brad was saying, check out the Halloween costumes we're going to see. And I said, everybody's going to be buying Barbies for their kids at Christmas, and probably can now as well. But the other thing is, for me, what I thought was really interesting here is that a movie about a doll that can spark a dialogue about feminism, which is actually kind of what happened in my house. I mean, I saw it with my 11 and 14-year-old sons, and they had thoughts about what it means to be a woman, what it means to be a man. And so, yes, it's a commercial, but it's not only a commercial, I think is what I would say.
Yeah, and I think that is why it is such a successful marketing effort. Mattel did something really clever here. So, I think one of the reasons critics love this movie, and they do love this movie, is it's very meta. It's very self-referential. There's a lot of winking at the idea of the original Barbie and how outdated the original Barbie is today. But Mattel was pretty smart. They allowed themselves to be part of the story, and they allowed themselves to be part of the joke. So Mattel does not have a benevolent role in this movie. They're sort of the evil overlords. And I would love to have been sitting in the board meetings when they were trying to decide, do we allow ourselves to be portrayed in this way in this movie? I mean, I think most corporations would not take that risk. So, I mean, I give Mattel credit for taking that risk. And even more than what you just said, Julie, that this is going to be Halloween costumes and so forth. There could be 50 follow-up movies. I don't know, Rick. Spoil the end
Not by Greta Gerwig, though, I bet.
Rick, here's the thing.
Well, I think a franchise is born. So now that Barbie has sampled the real world, and I don't want to give away the ending, but she develops an awareness of sexuality.
Sure.
Think about how much further this could go.
Yeah. Rick, I'm going to be brief with my movie takeaways here. I only got 3. Number 1, the Barbie core outfits. We saw them everywhere. And my takeaways are really more kind of secondary or tertiary market related even here as you think about going forward and where there could be some incremental pickup for other players who are capitalizing on this. So Barbie core outfits, but I'm taking the other side of you, Rick. I think it's a one and done Barbie box office moment for Mattel here. However, if I think about Apple Music and Spotify, you may have a Song of the Summer contender that drives up some of those streams here from Dua Lipa. So those are my quick takes here.
As before, we could talk for a long time about this, but we gotta go. Rick Newman in pink, thank you so much.
I'm telling you, the sequel is coming.
You made our day, buddy. All right, we'll see if you're right. All right, Jared Blickby's got you for the next hour of trading today. Keep it right here.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West, and I am Jared Blickery. Here's what I'm watching today. From Meta to Amazon, big tech earnings week is here. We break down the big tickers and dig into recent transcripts to highlight the trends important to investors. That's you. And it is day one of retirement week. We're going to speak with two experts on why it's never too early to set yourself up for success. Plus, a blockbuster weekend for the box office. Guess what? Barbie, who won the Barbenheimer battle, and what this means for other upcoming film debuts still to come. But first, let's take a quick look at the markets here. We are in an uptrend today. We got the Dow up 0.5%, S&P 500 a little bit under that, and the Nasdaq pulling up the rear, up about 16 basis points, and also getting a check on the Treasury market. Just looking at the 10-year, that is down about 1 basis point to 3.83%. Also seeing a little bit of down movement in the 5 and the 30-year tenors as well. So let's check up here and let's keep moving on. Earnings season, that is off to a full swing start here. And last week we saw major banks coming out. Tesla, they released their quarterly earnings as well, and so did Netflix. And now the much anticipated big tech earnings are set to be released throughout the week here. But what can investors take away from results this season, and what should they be focused on? Let's bring in Avondale Asset Management founder and editor of The Transcript, Scott Krisoloff, to give us his insights into what we've been seeing so far. Always great to see you here, Scott. And you've been perusing the transcripts, as I know you have, and we got some big bank earnings. The tone pretty good with respect to the consumer and the economy so far. Recession potential down the line. Just a smattering. What have you been seeing here?
Yeah, I mean, it's more of the same that we've seen for the last couple of quarters, which is a resilient economy, a resilient consumer. I think there's a lot of optimism still. I think the biggest, most noteworthy thing that we saw in the last week was that capital markets seem to be ready to start opening as well. Banks like Goldman Sachs, Morgan Stanley talking about robust pipelines in their investment banking business, really starting to see optimism come through.
Yeah, I've noticed I go down to the New York Stock Exchange every day, seen some big high-profile IPOs in the market. Want to talk about some other stuff that's happening, huge trends in AI, resurgence in interest this year, or I should say surge in interest this year. How are companies talking about AI on their earnings calls?
Yeah, I think there's a lot of interest in AI. Obviously, it's been a big driver of capital markets, our tech companies and the Nasdaq. Really getting a boost from AI expectations. I think one quote that really stood out to me was from Taiwan Semi, which we had in our newsletter this week, which talked about how the short-term hype in AI is something that may not carry through in the medium term, but is likely to persist in the long term, that the AI wave will continue to grow. But short-term expectations are extremely high, and that isn't necessarily working its way through to earnings, even for the semiconductor companies in the near term.
Yeah, it seems like that's going to take years to play out, but that's just my opinion. Also want to get your take on the residential real estate markets. We've seen mixed figures out of housing, but despite mortgage rates at 7-8% in some areas, we still see huge demand for housing.
Yeah, that's an incredible dynamic that's happening in the housing market. It's tough to explain, honestly. Mortgage rates up a lot, but still demand there. I think the biggest contributor to it is the fact that supply has been held low. And in some ways, higher mortgage rates are contributing to that. So if you already bought into a house, have a lower mortgage rate, it's hard to move and justify going to a much higher rate. So that's helping to keep supply low, which is helping to keep prices supported. But even demand is staying strong, it appears, despite these high interest rates.
Yeah, and just thinking about the Federal Reserve, which goes hand in hand with the rates, those are longer term rates. When we think about the Fed, we think about short term rates. Lots of expectations for this week's big announcement, but the consensus is that that the Fed hikes this week. But then, are they done? What are some of the banks saying on the transcripts?
Yeah, I mean, I think most companies are expecting for the Fed to hike one, maybe two more times, but really focusing in on one and then pause for a while, which is exactly what Jerome Powell has been trying to say to markets, get markets behind, is that interest rates may stay higher for a little bit longer in order to fight inflation. But I think people are thinking that we're pretty close to the end here on the interest rate increases, which I think is probably part of the reason why stock prices are a little bit more buoyant this year as well.
Yeah, and the proof remains in the pudding. We'll have to see what comes this Wednesday. We're going to be bringing that live for everybody. Also want to talk about the international front, especially China, the reopening. We know by now it's taken a lot longer and has been a lot slower than anticipated. Any signs that it's picking up, or is there just a general malaise over there?
I think we're still seeing a general malaise over there from what we're picking up in earnings calls. I think that as much of the story about China reopening and the obviously draconian COVID policies that they followed for several years, I think international companies are hesitant to be investing in China with the geopolitics in the country today. And so you're actually seeing one of the trends that we think is most interesting is the nearshoring, onshoring, reshoring of industrial capacity. In the United States, North America, one of the countries that's benefiting is Mexico. And you're also seeing companies do that in Europe as well. But I think without as much foreign direct investment going into China, that's probably helping to slow their economy as well.
And circling back to the consumer, you're noting in some of your writings today, there are elevated delinquencies in auto, loan growth slowing in other areas. So the consumer, as we have been saying, is resilient, but there are some maybe warning signs on the horizon.
Yeah, absolutely. I think the way that we are interpreting this at this point is just a general slowing of the economy. But on a nominal basis, inflation adjusted, or including inflation, the growth rates were so high for the last couple of years that even if you come back to 5%, 4%, 3% growth even, which is a more normalized growth rate, it feels like it's much slower than it was. And it is a slowdown. It's a quantitative slowdown from where we were. But that doesn't necessarily mean we're seeing negative growth at this point or recessionary type dynamics.
Excellent to point out there and noted. Thank you as always, Scott Krisloff, Avondale Asset Management founder and editor of The Transcript. In a surprise release, Chevron has come out with preliminary results showing that saw better than expected earnings on record output in the Permian Basin. It also announced some big management changes. However, the oil major reported its net income had dropped to $6 billion, marking its fourth straight quarter of lower results. And joining us now is Yahoo Finance's Ines Ferre to give us some more details. So we were just talking about this briefly before the show. The management change, the CFO also getting kind of transition out, but the CEO may be going to stay for a while.
Yeah, that's right. A vote of confidence definitely for the CEO, Mike Wirth, who is 62 years old, where the company has now waived the mandatory retirement age of 65. Also, Chevron announcing that its CFO will be retiring next year. So CFO Pierre Breber will retire, and he's been with the company for 35 years. A CTO will succeed Breber in March 1st of 2024. Let's talk about, though, the results, or these part of the results that were released early. They were released last night. Chevron will be reporting its full earnings results on Friday. But what's interesting is that they topped profit estimates, coming in at $3.08. The street was expecting $2.91 per share, but that was a decline of 47% year over year. Also going through some of the highlights from this report, their production in the Permian Basin set a quarterly record, and also Chevron saying that it has returned $7.2 billion to shareholders in Q2 in the form of dividends, in the form of stock purchases. So no changes there when it comes to these energy companies, these oil companies that are returning cash to shareholders. But what's really interesting, of course, is that the profits are declining, and we are seeing this. We will see this more in Q2 because of the price of oil, which has come down. Still, you had been interviewing a guest not too long ago talking about how these energy stocks haven't come down as much as you would expect, given their huge run last year. You had XLE last year up 57%, and now it's down about 4% year to date. But still, you would think that it would be down more. But as your guest was saying, these companies have...
yes.
Yes, exactly. They have a low debt. They have a healthy balance sheet. The question, of course, is if oil prices go down further this year.
Yeah, and we know OPEC Plus does not want that to happen, and they've been actively trying to prevent that. Another company in focus hasn't released yet, but maybe a little preview here, Exxon.
Yeah, Exxon. So ExxonMobil will be reporting its quarterly results on Friday. Analysts are predicting its earnings to come down 50% year over year to $2.04 per share. Revenue decreasing 30% to $81.8 billion. I did speak to one analyst this morning that was telling me that in the third quarter, the second quarter is one of uncertainty. ExxonMobil guided lower earlier this month, so the consensus for Q2 has come down about 10%. But again, the price of oil now, we are seeing it impact profits.
Yes, and still at the lower end of its one-year range there, so we'll have to see what comes of that. Thank you for your report, Yahoo Finance's Ines Ferre. All your markets action ahead. Stay tuned. You are watching Yahoo Finance.
Does anyone really understand AI?
Well, I'm sure there are experts who do, maybe the ones who are kind of building out the infrastructure. I actually think the whole concept of AI might be overly simplified, and I think there are so many different avenues you can go. Much like the internet, everybody compares it to 20 years ago. Look how many use cases there are for it, and there have been, and then the technologies that have kind of spurred from that. So I think the mistake would be to assume it's just this one monolith that we can kind of copy paste onto everything as a descriptor. There's probably a lot more that comes from it in different industries. And one of the reasons that I don't think AI is just a tech play, I think it's many sectors, actually the beneficiaries of it, that might end up doing a lot better because they can kind of right-size businesses that way.
Let's do a check of the market sponsored by Tasty Trade. You can see we're in an uptrend here. The Dow up more than 0.5% now. S&P 500 close on its heel, and the Nasdaq the laggard, but still up about 0.33%. Now, retirement might seem light years away for some, but when it comes to getting started with your retirement planning, are you on the right track? A new study from Northwestern Mutual showed Americans expect they should save nearly $1.3 million for retirement. But the average U.S. adult only has 7% of that target amount in the bank. So what can you do ahead to plan? Carrie Carbonaro, Advisors Capital Management Senior Vice President, and Mark Miller, author of Retirement Reboot, Common Sense Financial Strategies for Getting Back on Track. They join me now. Carrie, let me just throw this to you. We've had an incredible year in the markets, but admittedly, it's left a lot of people behind, just kind of demonstrating why you need to be in the market. Yeah. How should younger people be thinking about their retirement needs right now?
So young people necessarily don't always think about their retirement because they always have other priorities that they put ahead of retirement. But I always say you can't borrow for retirement. So you have to start and you have to own your own financial future. So all the young people, I need them to get on budgets and then find the money in their budgets to contribute to their 401ks or IRAs or any type of workplace retirement plans, because if they start now, it is amazing how compounding interest will grow for them over time, and they are going to meet that retirement goal of $1.3 million, at least as it is today, if you've got 30, 40 years to save.
And Mark, similar question to you, and I'm noting as you're writing to us, at least half of us are on track for an unsuccessful retirement. How do we fix that?
Well, yeah, and that just defining that simply is the ability to maintain your standard of living in retirement. You know, with respect to younger generations, a couple of key concerns that I have are that, you know, fewer young people are going to receive traditional defined benefit pensions than previous generations, which are incredibly important sources of retirement security. And also, younger people are going to receive less in Social Security benefits when we look at that in terms of the amount of pre-retirement income that Social Security replaces will be lower for everybody born after 1960 because of the higher retirement ages put in place. So, you know, I agree that the good news is that, you know, time is on your side when you're young. I agree with Carrie's point there in terms of compounding, but I would just add this. I actually think, even though I write about retirement for a living, I think sometimes there are other things you should be doing first. You know, I don't think you should be carrying high cost debt, for example. You know, if there's an available dollars to use, I would use it to reduce high cost debt rather than going into a 401k. But that said, you know, so I think cleaning up your household budget is critical, and getting even small contributions. I often tell young people, put away what you can, even if it's a small amount, because it will compound and redound to your benefit over time.
Carrie, we've seen dynamics of the pandemic play out over the last few years. We've seen retirement kind of get redefined in a few different ways. We have the rise of the gig economy, so older people now have more options for doing part-time work. What are some of the trends you've noticed change with respect to retirement and retirement thinking over the last few years?
So there's a lot of retirement rewirement I've heard that term a lot.
I like that.
Where people are deciding what is retirement. Am I going to retire? Am I going to just slow down and get a part-time job? There's also the 3 different phases of retirement. I don't know if you've heard of them. The go-go, the slow-go, and the no-go. And so that actually affects how much you need to save, and that you're going to be spending a lot in the beginning, you know, medium amount in the middle, and then, you know, not as much in the end when you just can't move as much anymore. But what's also interesting with the new gig economy and everything is something that we never had before is the social media success porn, which a lot of people are looking at. You know, young people and people pretending to be rich and having these amazing lifestyles. And it's all really not real. You know, the TikTok and Instagrams of the world are showing all this, and people are actually believing it. And I always say, there's no get rich quick, only get rich slow. So be careful where you get your advice from.
Yeah, so social media might be misleading. I can take that. I'll believe in that. Mark, I want to take it back to you. We've been talking about some of the younger generations here. What if you find yourself maybe in the middle stages of one's life and you haven't just saved enough? How do you catch up? What are some of the strategies that somebody who's a little bit older but hasn't saved enough can use to get on track?
Yeah, that's really the core focus of my book. And what I'm trying to explain in there is that even for people who are getting a late start, there are definitely steps you can take. So one of the most important ones, I think, is to understand the critical importance of the timing of retirement, which I think Carrie was just mentioning. Working even a few more years than you had planned can be an incredibly important lever, both because it allows you to delay your Social Security filing and hence claim higher benefits from the delayed retirement credit. It might allow you to do more catch-up saving late in the game. And net, it means fewer years that you're going to be financing through your savings because you're pushing out that retirement date. So I illustrate that through some hypotheticals, in the book. And I think, there are definitely things that people can do. I have a chapter in there on home equity. And, for most households, even those that haven't saved in retirement accounts, the majority of older households do own a home. And so, the home equity turns out to be the largest source of savings for lots of Americans. So it would be silly not to at least consider tapping that one way or the other, whether that's downsizing and moving or other means. So there's just some of the things that I explore in there. I think it's important to be really careful and thoughtful about your Social Security claim. And it's really important to understand healthcare, the cost of healthcare and retirement, and the importance of making smart decisions about Medicare.
And Carrie, your thoughts about the timing of retirement and how that fits into planning for it?
Sure. So it obviously it depends on what you're planning, when you're planning, where you're going to live, how much you're going to spend. There's so many factors, your longevity of your life. There's so many things that go into this. And I always say there's no one size fits all when it comes to financial planning. So I believe, getting with an expert, if it's really serious for you, to go in and make sure that you're maximizing everything that you're doing on your savings, make sure that you're making the right decisions, like Mark said, about Social Security. When are you going to take it? Do you have a pension? Obviously, most people do not at this point. So that makes a big difference of why retirement planning is so important today versus what it was 25 years ago when we had pensions and when the onus shifted from pensions to 401ks, which now the onus is on us. Also, I believe that it's really important, where are you going to live? Are you going to, yes, you're going to tap maybe your equity in your home, but are you going to downsize? And what states are you going to live in? Because obviously some states are more budget friendly when it comes to retirement. Mm-hmm. And that could really make a difference with, can you retire successfully or not? Could be even where you live.
Yeah, important. Yeah, the importance of, could I just add something
jump
there?
In. We got time for one more. You got the last word.
Thank you. Regarding getting advice and planning help, I think it's really critical for people getting closer to retirement. I think when you're young, the big goal is just save as much as you can, clean up your household budget. But things get more complicated as you get close to retirement and in retirement. So, I include a chapter in the book about how to hire a planner. I think you want to look for a fiduciary planner who can help you, who's, obligated to put your interests first. And that's, planning help can be great, but you have to find the right type of help.
All right, really appreciate
Mark, that's me.
Really appreciate both of your insights here. Thank you for stopping by, Carrie Carbonaro and Mark Miller. All right, pleasure. Coming up, all your markets action ahead. Stay tuned. You are watching Yahoo Finance.
Barbie or Oppenheimer?
I gotta say Barbie. I think it's just, it's fascinating when they bring something to life, so to speak. Mm-hmm. That's been a big part of the culture of the world for a long time. I think it's fascinating to me.
I don't know if we've talked to anyone who said Oppenheimer. Maybe one person.
Maybe one, yeah. It seems, at least in the circles I'm in and the channels I follow, it seems like Barbie's got the upper hand in terms of interest.
Barbie domination.
Domination, absolutely.
Welcome back. It was a monster weekend for movie theaters with Barbie and Oppenheimer filling seats all over the U.S. The two blockbusters brought in a collective $235 million domestically and set up the fourth largest box office weekend in history. Yahoo Finance's Alexandra Canal joins us with all the details. Allie, I could not get tickets at 9 a.m. on a Saturday, so I know the theaters were packed. Give us some of the details.
Yes, and I mean, we shouldn't really be surprised because the talk heading into this weekend was so huge, especially for Barbie, which committed to a really strong marketing push. You were just seeing some of those numbers on your screen, and it's truly phenomenal. $155 million for the three-day haul for Barbie, while Oppenheimer brought in just over $80 million. And those sales balloon even more when you take a look at overseas markets, with Barbie collecting another $182 million internationally compared to Oppenheimer's $93.7 million. We're seeing a lot of those theater chains rise today on the heels of that news. Same with Mattel, which backed the Barbie movie along with Warner Brothers. And I just gotta say, I went to the theater this weekend. I have some pictures from my local theater. This is a small town theater. And look, they had a Barbie display. I had to wear pink, of course. Barbie display. The line to get concessions was honestly 15 minutes long. I, of course, ate my weight in popcorn and Swedish fish and Coke. But that's what you have to do for the movies. AMC actually said it was the second highest day of all time for those food sales, which is crazy. So people were going to the movies. They were eating. I think a big part of why this weekend was so successful is we've seen a lot of franchises, and there's been a little bit of fatigue there with the Marvel superhero films. Even a film like Indiana Jones, which has been a long storied franchise, it's been out of the public perception for a bit of time.
Since I was a kid.
Exactly.
Basically.
So it seems like those types of movies aren't resonating with moviegoers as much as they previously were. And that, I think, is going to cause studios to rethink how they approach some of these movies, because clearly right now consumers seem to be craving that original content, some of that newer IP that we haven't seen in quite some time. And I think the success of both of these films really proves that theory, that as long as you have good quality movies, solid word of mouth, and maybe perhaps a big budget when it comes to marketing,
that helps too.
You're going to do well at the theater.
All right, talk to me about the concessions lineup for Oppenheimer, because I don't, Barbie, I can see, all right, people consuming lots of snacks. Oppenheimer, is that going to bring people in the same way? Is it going to attract the same audience? And I ask this with a little bit of tongue in cheek because Barbenheimer, people have been doing this back to back, so clearly there is some crossover interest.
I tried to do the back to back and I couldn't get tickets because Oppenheimer was sold out, so I had to see that separately. Oppenheimer is a totally different movie. It's 3 hours long. It's obviously a lot darker than the Barbie movie. There's been a lot of debate on which film you see first. Maybe it's Oppenheimer and then you have Barbie as your palate cleanser. But this is a movie that I think could actually sustain some box office momentum. I think a lot of people for the Barbie movie, they're going to want to see it as soon as possible. They want to avoid the spoilers since a lot of people are talking about it on social media. But Oppenheimer, it's a longer movie. It's Christopher Nolan at his finest. I think we could see a sustained momentum over time, which I think for any film is important.
Yeah, I think I could cleanse my palate on Oppenheimer, for instance.
There you go.
I'm going to cleanse my palate on something next weekend. I guarantee this. But Allie Canal, thank you for stopping by, as always. AMC shareholders, they voted for it, but a judge said no to a class action settlement that would have paved the way for a conversion of AMC preferred stock, the so-called APE shares or units, into common stock. The Delaware Chancery Court judge ruled after the bell Friday that the settlement, worth over $100 million, waived too many claims against AMC. Now, in response, AMC filed a revised settlement agreement over the weekend, which will be made public today. And the CEO, Adam Aron, he was addressing investors in a letter posted on Twitter saying it's critically important to get the deal approved, which paves the way for AMC to raise new capital. Aaron wrote, that is especially the case now with the added uncertainty caused by the writers and actors strikes. AMC common shares initially popped over 30%, while the APE shares, which closed Friday at about $1.75, dropped an entire dollar, but have now stabilized around $1.76. So basically a big to-do about nothing there. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
What is the best piece of career advice you've ever gotten?
I think the best advice would be not as much figure out what you're good at, but figure out what you're not good at and what you don't like. Because we're pretty good at figuring out, what we like to do on a day-to-day basis. But when you're put into a job where every day you're doing something that you really don't like and you really can't stand, I think that kind of starts to eat away a little bit. So I would actually say, someone who told me a long time ago, figure out what it is that you don't like to do. Try to, find that, whether it's in an interview or kind of the first stages of getting to know a company. That's probably going to help you out longer term.
UPS and the Teamsters Union are set to resume talks on Tuesday, leaving the two sides with less than a week to come to an agreement on their current contract. If they do not, significant upset could occur in the U.S., supply chains that could hit the general economy. Let's bring in now Yahoo Finance's Alexis Keenan to discuss more. Alexis, the latest, please.
Yeah, Jared. So, 7 days to get this deal done.
Yes.
Talks resume tomorrow. And these two parties to get to, yes, they still have some things outstanding. And let's take a look what is still at issue. Still not settled. Wages for approximately 100,000 part-time workers at UPS. These are workers who load and sort in the warehouses. They want their wages increased. They already get the benefits that full-time employees get. So that may not be as much of an issue, though we don't really know. Also, what we don't know are the issues for the full-time workers. These are the regular old UPS full-time workers that deliver the packages to your front door and to the doors of many businesses around the country. They make average of $42 an hour. We don't know what their demands are at this point. As for those part-time workers, they currently make about average of $20 an hour plus benefits. All of these employees getting the same benefits and pensions regardless of where they stand in that hierarchy. Already agreed to, though, UPS tells Yahoo Finance that they are converting a hybrid group of workers. These are full-time workers that work Tuesday through Saturday to full-time worker status. They currently make about precisely $36.54 an hour. These are kind of hybrid workers who work both in the warehouse as well as deliver packages. But we do have some estimates now coming from the Anderson Economic Group. And what they say is that a 10-day strike could cost the U.S. economy approximately $7 billion. They talk about lost wages for those 340,000 workers who would be furloughed. Also lost to customers. They estimate that to be about $4 billion. And then lost revenue for UPS as well. So a lot still to be settled here. The parties, though, getting back to negotiations, hopefully first thing tomorrow.
Hopefully, and it's important to point out that we haven't had a situation like this since 1997.
Yes.
So a lot of new stuff to potentially deal with. When it comes to the United States Postal Service, what are they saying about their ability to pick up packages, do their job, if there is in fact a strike?
So,
yes.
The Postal Service, they say they do have the capacity to fill any stoppages that would be happening at UPS, though there are other experts who say that no, there would be some holes in the system, and after about a couple weeks, there'd really be some stress. And you have to look at inflationary pressures too, because if UPS is not in the mix, you now have FedEx, you have Amazon, you have others picking up the slack, sure. USPS included, and they could take advantage of this situation and raise prices for both, regular consumers like you and me, as well as businesses. But just quickly take a look at the extent to which the U.S. economy is reliant on UPS. In 2022, of 21.2 billion domestic packages delivered, according to Pitney Bowes, you had UPS accounting for 5.2 billion of those packages. That's roughly 24%, just behind USPS, who says they have the capacity. They were delivering 6.7 billion, FedEx at 4.1, and Amazon at 4.8 billion. So big numbers there, and whether or not these other players could pick up the slack, we hope we don't see.
Yes, I forget how big Amazon Logistics has become over the last few years. Thank you for that, Alexis Keenan. The Federal Reserve is set to meet once again this week in its ongoing fight to combat inflation. Many investors have dialed back on the recession expectations, instead thinking we'll hit a soft landing. And that's according to the Bank of America Global Fund Manager Survey that came out last week. Now, this has been helped by easing inflation, but still, they remain unsure about what the Fed's next step may be, with its 2% target still a little bit out of reach. Let's bring in now Global X Chief Investment Officer John Mayer to give us his insights. And John, so you can paint with some broad strokes here as we get situated, but the Fed meeting in 2 days, decision in 2 days, it's a really big one. And what should we expect?
Well, I think it's pretty much a certainty that the Fed's going to raise by 25 basis points. There's about a 94% chance. So it's a foregone conclusion. The market knows it. So the question is, what are they going to say in their discussion when Powell speaks? And that's the real big point the market is looking for. We know that there are sticky points. Labor is sticky, housing is sticky, and the consumer is holding up the economy. So the question is, how much are they going to add to inflation? I do believe that the Fed is going to be a little more hawkish, but they might throw in some dovish lines because inflation has been coming down, but will it last?
Yeah, and it's really all about what Powell says when he takes to the podium and the lectern at about 2:30 on Wednesday, which we're going to cover live. I want to get to your notes here. Three key areas keeping the U.S. economy afloat: consumption, labor, and housing. And a lot of surprises here. A lot of surprises not only from the retail investing public, but also from corporate CEOs in their transcripts about how well the economy has held up in the face of all this Fed tightening. So consumption, labor, housing, how do these three interplay here?
Well, the consumer is really holding up the economy. So right now we know the cumulative savings rate is being depleted, but is still fairly high. We are seeing actually the savings rate tick up a little bit because people are concerned that they're running out of savings from the different pandemic programs because of the cumulative savings. But the consumer is still spending. We are in summer. People are excited to be out, and we are seeing labor strong. in the service, particularly the service and leisure area. Now, what happens at the end of the summer when some of these summer jobs fall off? If you do look at some of the higher quality jobs, folks coming out of college, it's much more difficult to find even an interview. So there are some signs there that labor may be falling off, which is actually what the Fed wants.
And housing. Yeah,
and housing.
Big one.
Housing's a big one. There's not enough supply. We are seeing building stocks doing very well because there's just not enough supply. People are stuck in their 2.5% to 3% mortgage. They can't move.
Well, stuck, that's not a bad place to be if you're only paying that much. But if you want to move, sure, I totally get that. Want to move on to recession talk. The last time I believe the Fed had a soft landing or a no landing was 1995 after an aggressive hiking cycle in 1994, and not much else beyond that. Is it possible this time to escape recession?
Well, first of all, this recession or non-recession has been so telegraphed for the past almost 2 years at this point. I do think that the market is forward-looking. Recessions are the shortest part of a business cycle. If we do experience a small recession, the market is looking forward, from my opinion. You are looking at other areas in this narrow leadership that it's been driven by AI, and that is certainly helping the market. It's been a kind of a narrow leadership, but it is broadening out some, and you are seeing investments in private equity. And the AI story, from our perspective, is a real story.
What tickers do you like or themes do you like within AI? Because it's a pretty broad field.
Well, if you look at the earnings, this earnings season, you are still seeing that CapEx is very strong, 15% year-over-year gains, quarter-over-quarter, as well as last quarter was 14% quarter-over-quarter. So we've been in an earnings recession, but this CapEx cycle is very strong, which makes it a very unusual situation. The thing is, you have to drill down, it's efficiency. There's not enough labor, so companies have been underinvesting themselves for the past 10 years. You're seeing the CapEx cycle really strong because of that. Reshoring, friendly shoring, related to the dynamics post-pandemic. So companies are all about efficiency, and that leads to robotics, and then AI is that new story.
Yeah, and it's finally great to see CapEx catching up after probably a decade and a half in hiding after the global financial crisis. John Mayer, thank you for your insights here. Always great to have you around. All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Where will CPI be a year from now?
Well, I think if we were going to almost play the game of base effects, like CPI was flatter this June because of last year, we hit the peak. Maybe a bit higher if you get a bit of a stabilization in commodity prices and energy prices, and then you don't get as much relief on some of the stickier parts of inflation. But I think for the most part, hopefully we'd be stabilizing, but we haven't been focusing on that as much, and as you and I have talked about a lot, the Fed hasn't been focused on that either. They've been focused on other metrics that have been a little bit slower moving to the downside. So I think it ultimately depends, in my view, on the labor market, how strong wage growth is. If we do start to see a little bit of a loosening, if you don't, you probably have a scenario where you're a little bit of a higher inflation plane.
What is the best piece of career advice you've ever gotten?
I think the best advice would be not as much figure out what you're good at, but figure out what you're not good at and what you don't like. Because we're pretty good at figuring out, what we like to do on a day-to-day basis. But when you're put into a job where every day you're doing something that you really don't like and you really can't stand, I think that kind of starts to eat away a little bit. So I would actually say, someone who told me a long time ago, figure out what it is that you don't like to do. Try to, find that, whether it's in an interview or kind of the first stages of getting to know a company. That's probably going to help you out longer term.
Earnings season looms for big tech, but last week there were different issues afoot for the giants of the space. Representatives from the likes of Meta, Amazon, Microsoft, and Alphabet, they met at the White House to discuss regulating artificial intelligence. The companies agreed to voluntarily safeguard information and better manage the risks posed by artificial intelligence. Now, after the meeting concluded, Meta's president of global affairs, Nick Clegg, told Yahoo Finance Live's Shauna Smith and Ali Garfinkel that he believes all the tech companies at the meeting want to move AI technology forward and quickly, but also responsibly. We also got Nick Clegg's view on the risk of political interference as we head towards a presidential election, and here's what he had to say.
The way we build our systems, not least our AI systems, which make sure that bad content, nefarious content, whether it's disinformation, whether it's foreign attempts to interfere in elections, whether it's hate speech and so on, those systems will tackle content regardless of where it's created, whether it's created by a human being or by a machine. So whilst the volume may change, the fundamental architecture of our protections, which we've built up over the years, and not least because of the experience of what happened back in 2016, and because of the immense advances in AI. I mean, we've spent $16 billion over the last few years on those kind of defenses and protections. We have tens of thousands of people working on this around the clock. Those AI systems will tackle misinformation, disinformation, where we can identify it, regardless of its source. And that's, I think, important to remember. It's not as if, as I say, the velocity and volume may change, but the fundamental power we have is because we are a platform that can control the distribution of that content. Is as long as we can identify it, we can then restrict or even remove that content if we find it.
Nick, this all totally makes sense to me, but my question is, how do we know it's going to work? Let's fast forward 18 months, let's say. The election is over. How do we know that Meta has succeeded in mitigating misinformation?
Well, look, my crystal ball is no clearer than yours. All I can point to you, so I can't tell you exactly what's going to happen in the future, and particularly not in something as unpredictable as elections. What I can reassure you about is that, do remember we're a global platform. Over 95% of our users are outside the United States, and we have elections every single month in many different parts of the world. So it's not as if we only ever have to prepare ourselves for the US election. We have teams, we have highly sophisticated automated models which are working to deal with elections non-stop, all year round, month in, month out. And with each election, we learn more because it's a very adversarial space. So I do think we're getting better. We have constant practice in doing this. We have made massive investments, I think, world-beating and certainly industry-leading technology to deal with misinformation, disinformation, and so on. We give users as much information as we possibly can. And as I said earlier, it doesn't really matter from our point of view whether the material, if it's unwelcome and we want to block it or restrict it, is produced by a machine or a human being, we will try and tackle it. But so I can only sort of tell you that I think we try our level best, and we do so on an ongoing basis. But exactly how that'll play out, well, that's something that obviously we can speak about after the elections themselves.
That was Yahoo Finance's Shauna Smith and Ali Garfinkel speaking with Meta's president of global affairs, Nick Clegg. Well, it doesn't get any bigger than 30%, and that's what the S&P 500 fraction of companies reporting this week is. Their earnings with Microsoft, Alphabet, Meta, and Intel, the standouts. And guess what? We got Brad Smith in the house here to talk about some of the consumer stocks that are also in focus, McDonald's, Chipotle, et cetera. And we're looking at the sector action for today. But show us what you got on the Wi-Fi Interactive for us.
Yeah, there's going to be a couple themes emerging as we get into the throes of the S&P 500. 500 portion of companies that are reporting earnings this week here. And as you mentioned, that 30% figure, Jared, I can't help but think first and foremost about some of the S&P 500 performing sectors that we've been watching over the course of this year. So just to bring us up to speed as to where we've seen performance outpace and then on the other side of that lag behind some of the S&P 500 performance, where the index overall is up by about 18% over the course of this year. Technology and communication services have been two of those outperformers. Of course, for technology and consumer discretionary, a bounce back off of what we had seen in terms of performance during 2022. And so here in 2023, in the first half at least, the story has been that rebound, has been that bounce back. And for some of the big tech companies that are going to be reporting this week, one of the major asks that you might hear on some of those earnings calls is certainly around artificial intelligence. But the questions now more is not just, all right, how does that infuse itself into your business, but how much are you spending on it? We were low on some of those numbers, even as artificial intelligence seemed to be the magic word that many of these companies deployed during the previous quarter's earnings season. And so now as we get into the throes of where are you investing, where is that R&D, what is the capital deployment looking like towards some of those initiatives, and when is it actually going to become accretive to margins at the end of the day? So that's something that you can look forward to this week as we get into some of those mega cap tech stocks. Since I mentioned those, we've got a few of those up here on your screen. You can see the year-to-date performances. I won't go into all of them here, but at the same time, that's going to be a thought. And you mentioned consumers, Jared, as well.
Consumers, people are interested. Well, consumer staples has been a safe haven, hasn't done as well this year. Can you do me a favor? Can you just put a 1 month time frame on that heat map? It's going to be, there you go, right in there. Because we've seen a dramatic change in what's been doing well this year so far. And you can really see that in the Dow, but also some of the laggards have caught up there in the Nasdaq 100 as well.
Yeah, absolutely. And so as we were mentioning kind of the environment for the consumers right now, there's a few of the key words that you're going to be looking out for as well from these more consumer-facing companies. And that is going to be how they're defining the resiliency of the consumer. And resilient is exactly the word that many of the analysts and economists that we've spoken with here on Yahoo Finance are expecting to hear time and time again. But it's going to be interesting to see at what volume those purchases and what prices those purchases are taking place. And so for the pricing, and let's kind of look into one company here that's within the Dow. McDonald's is one that catches a lot of people's attention. The Golden Arches or Arcos Dorados, whatever you want to call them, here going into earnings. They've had a performance year to date that has kind of lagged the broader performance of the S&P 500 at least, but for the Dow Jones Industrial Average, you'll remember that that has been the worst performer of the good performances we've seen on a U.S. major average basis here. So it'll be interesting to see what McDonald's has to say this week.
I just want to point out that over the last 2 months, McDonald's has gone sideways. Well, what happens if it pops here? We got to go. So I appreciate you stopping by there and helping us out at the end of the show. And let's do a final check of the overall market here before we go. And you can see the Dow still heading and leading the game. It's up almost 200 points, up 0.5%, followed by the S&P 500 and the Nasdaq up about 0.2%. That's it for now. I'm Jared Blakely.